Very good morning, friends. So I hope you're enjoying the coming of the next year, that is 26. And we are also enjoying the standard, that is business combination. So I think we've come a long way in terms of business combination standard. And I hope you're doing your cumulative revision as well, because today I am going to do the comprehensive questions on the accounting of business combination. We've already gone through the detail on the 7-step model, which applies in the case of acquisition accounting. And today we'll see a full-fledged question which applies all the 7 steps as far as acquisition accounting goes. We'll also pick up a question on the concept of reverse acquisition. There is a slight little inputs which are required on the calculation of the purchase consideration. Largely, of course, the accounting is same, but of course there are here and there differences. So once we're done with a full-fledged question on acquisition accounting, we'll come to the question on reverse acquisition. And then we've also got another input as well, and that is the common control transactions, that when there is a business combination between related parties, then what is the kind of accounting? Now that's pretty easy, because when it comes to a common control transactions, the accounting is based on what we call the pooling of interest method. Something what you've done in AS 14, that is merger, when you apply the concept of a pooling of interest method. But prior to that, we're going to first of all start with a full-fledged question on acquisition accounting. So you want me to do a little warm-up exercise of doing a simple question or directly take to a certain level of question? Though I am thinking to take you to a certain level, why a simple question? I think we've come a long way. So let's do a bigger, larger question itself. What do you say? Ready to go to the larger question itself? I think we can directly go to a better question indeed. I think so. Yes, that's great. So I'm just going to first start with a question in the study material, and that's a comprehensive question which is covering the aspect of acquisition accounting. This is illustration number 40. So this is the illustration number 40. Let me just crop this up to show you. In the study material, it is illustration number 40 by the name of Professional and Dynamic Limited. I guess that should be pretty much visible indeed. Let me also zoom the other part of the question as well. So there are a lot of things we need to read the question very carefully indeed, because I think reading the question is the most important task. A lot of insights comes into account as you read the question. I hope, friends, it is clearly visible to you. You can see it clear. Okay, so let's, I think, begin the journey. So I'm going to first read the inputs to you. Let's read illustration number 40. It says the balance sheet of Professional Limited and Dynamic Limited on 31st March X2 is given. So I think there's nothing which I can see much on the balance sheet so far. I think whatever data we need, we'll see it later. And then in the additional information, I am given that Professional acquired 70% shares of Dynamic, and that is on 1st April X2. Now, the only thing you need to be careful on is that this is the balance sheet on 31st March X2. And we acquired the shares on 1st April X2, which means this balance sheet would not contain any investments. This balance sheet would not contain any investments which Professional made in terms of Dynamic. And then it says by issuing its own shares, and that is in the ratio of 1 share for every 2 shares in Dynamic. That means the purchase consideration is in the form of shares, and immediately what should come to the mind is when you calculate the purchase consideration, we need to consider the fair value of the shares which are issued. Then he says the fair value of the shares of Professional is 40 rupees per share. Then he gives you the fair value exercise resulted in the following. So I am given the fair value of PPE. So when you go to consider your step number 3B, As we read, you should try to relate that this information is going to be pertinent in which step. So when you're going to make a list of the net asset in step number 3B, then we're going to consider the fair value of this PPE. And if I am given any tax rate, it will also lead to deferred tax implications, which you're going to consider in step number 3A. And I'm just thinking in large, because when you read the question, you should be able to get a formation in the mind that this is how I need to think. Then he says professional also agreed to pay an additional payment as a consideration, that is higher of 35 lakhs and 25% of any excess profits in the first year. Now, this needs a little evaluations at this stage. It says professional agreed to pay an additional payment, which is going to be the greater of the two. Let me just, I think, write it down and understand this in a great detail. It says we are going to give a payment which is supposed to be higher of the two. It is supposed to be 35 lakhs, or it says 25% of the profits, 25% of any excess profits. So whichever is supposed to be greater, that payment is to be given. Now, let me make some observation at this stage, and you can vouch me on that. So when I tell the shareholders of the equity that I'll give you the greater of the two payments, now let's assume for understanding perspective, let's say 25% of the excess profit comes to, let's say, 10 lakh. Then how much payment are you going to give? The higher of the two, which means 35 lakhs. And let's assume that this 25%, let's say, comes to a total of 48 lakhs. Then how much are you going to pay? You're going to pay 48 lakhs. So I'm just thinking that if 25% of the excess profit comes to 10 lakh, you're going to pay 35. And if it comes to 48, you're going to pay 48. So can I say you are in any case going to pay 35 lakhs? Is the observation correct? You're considering that either the two figures comes, you are going to pay a minimum of 35 lakhs in any case. Correct. So if you're going to pay a minimum of 35 lakhs in any case, so can I say that this is a guaranteed payment? It does not depend upon any ifs and buts. And if you remember the three-step input which I gave you regarding the DC and the CC, I said if there is a payment in the future and it is not dependent upon any conditions, on the very apparent level, it seems that it is based on a condition. And the condition is 35 lakhs or 25% of the excess, whichever is greater. But at the end of the day, if you look at the language, we realize that this amount is any case going to be paid. So this will become a deferred consideration and not a contingent consideration. I hope you got the concept clear. Because we know that irrespective of the outcome, that whether 25% of the excess profit is more than 35 or is less than 35, you are going to land up paying this 35 lakhs for sure. And if it is a payment which is going to be paid for sure in the future, it is a deferred consideration and not a contingent consideration. Okay, that's great. Now let's come back further. So can I say that if there is any excess payment, over 35 lakhs, that is contingent in nature. So we can say in this case, if you're going to see that there is anything in excess, so if you get any excess that is over and above 35 lakhs, if you're going to get that excess, then we can say that is something which is contingent consideration in nature. So whatever amount gets paid, 35 lakhs is guaranteed to be paid irrespective of the outcome. And if there is any payment in excess of 35 lakhs, that's going to be contingent. So this indirectly becomes, you can say DC as well as a CC combined. Okay, now let's come back. So we're going to spend some time reading the question carefully because that's a very important deal. Then he says that in the first year after acquisitions, over the preceding 12 months profits. Now it says this additional amount is due after 2 years. So it's going to be paid in the future. Dynamic earned 10 lakh profits in the preceding year and is expected to earn another 20 lakhs. When it says it is expected to earn another 20 lakhs, that another 20 lakh means the excess. Because he earned 10 lakhs in the preceding year, now he's expecting to earn another 20, that makes it a total of 30 lakhs. So he says that we'll give 25% of any excess. So if you're going to pay 25% of any excess, that figure in any case comes to 5 lakhs, which means based on the estimation, you are saying 35 lakhs or 5 lakhs, whichever is greater. So there is no possibility of this excess being paid, because the company is expecting that the excess profit is going to be 20 lakhs, and when you're going to pay 25% of that, that works out only at 5 lakh rupees. So therefore, we are not given any fair value of this contingent consideration, because the payment of this contingent consideration is not expected to be paid, and therefore we are not given any fair value. So we are not going to add any contingent consideration in terms of PC, because it is not probable to be paid, and therefore no fair value estimation is also given. Okay, that's great. Now let's come to the next point. It says, in addition to the above, professional also agreed to pay one of the founder shareholder. So founder shareholder, that means that this fellow is not only the employee, you can say, because he's the founder, so he's the founder shareholder, so he might be an employee come a shareholder of the acquiring company, both an employee and both a shareholder. So now we need to see that the payment is in which capacity. It says a payment of 20 lakhs will be given if he stays with the company for 2 years after acquisition. So would you like to tell me that this is paid in the capacity of employee E, or is it paid in the capacity of S? And that's right, it becomes a CCE, because you're telling him to stay for a period of 2 years. So the payment will be given only on the founder member staying in the company for the next 2 years. Super. And then it adds on further that Dynamic had certain equity settled share-based payments. That's called the original award, which was replaced. When it says which was replaced, is there any specific input coming to your mind? It says it was replaced. Does this mean that this is a case of a mandatory replacement? Because SBP has got 3 factors: mandatory, optional, and no replacement. So can I say this is going to be a mandatory replacement in this particular case? And we know what is to be done. It says by the new awards, as per the original terms, the vesting period was 4 years, and on the acquisition date, the employees have already served 2 years of service. As per the replace awards, the vesting period is reduced to 1 year. So out of 4 years, they've already put in 2 years of service, and now we are given that the remaining period stands reduced to 1 year from the date of acquisition. So we know that when we're going to consider the calculation of the purchase consideration, we need to consider a proportionate fair value, which is based on the vesting period completed upon the total or the original vesting period, whichever is greater. So at that stage, we'll consider this information. Then I am given the fair value of the original award as well as the replacement awards on the acquisition date. And there again, we're going to apply a 3-step model in terms of calculating that in the purchase consideration. Then he says, Dynamic has got a lawsuit pending with a customer who made a claim of 50 lakhs. The management reliably estimated the fair value of this liability to be 5 lakhs. If there is a lawsuit pending with a customer, it seems that it must have been a contingent liability in the books of acquiry. Now, since the fair value of this liability can be estimated, is it going to be a part of my acquisition accounting? Are you going to consider this in step number 3B? Is this a part of the exceptions, those 8 exceptions which we did in step number 3B? It's a contingent liability whose fair value estimation is already given. So are you going to consider this as a part of the list of net assets in step number 3B?
Yes, sir.
Wonderful indeed. And then it says, and then, we also need to be careful that this item, that is this item PPE and this item will lead to deferred tax implications if a tax rate is given in the question. Then we're very clearly given a tax rate, which means deferred tax implications as well. Now you're required to prepare an opening consolidated balance sheet of professional on 1st April X2 and assume that there is a 10% discounting rate, which I need for a DC. A lot of information is given. But I think the only thing what you need to do is go on a step-by-step basis, concentrate on, what are the crucial inputs under each step. Once you're able to do that, we get the results. And one of the questions which is pending on a discussion, which I always said I'll tell you later, and I'm going to answer that question today. What is the relationship between Ind AS 103 business combination and Ind AS 110? Because we said that once you get a control over the business of the acquiree, it triggers the concept of 103 one time on the date of acquisition. So I'm yet to give you the concept of relationship between the two standards. So as we're going to progress to Ind AS 110 in the next session, I think it's important, first of all, to understand the connect, that what is 103 and 110, how are they connected? So based on the requirements today, we're going to understand when it says make an opening consolidated balance sheet, we're going to get that connect also today. Let's, I think, begin the journey. So we are solving this particular illustration on a step-by-step basis. As I said, this is illustration number 40 of the study mat. So I'm just going to give the reference. We are solving illustration 40 of the study material. Now, we're going to go step by step, and if there is any trouble in between, do stop me. But I think if you revise your concepts well, you're going to enjoy the movement of this particular illustration. So first thing, what we're going to do is step number 1, and that is identifying. And that is identifying the accounting acquirer. The first thing what we're going to do is identify the accounting acquirer. As I said, this is a very crucial step because this also helps you to decide whether it is a case of acquisition or it is a reverse acquisition. Now let's assume that you're doing these questions as if you've done the entire standard. So what should come to the mind? Am I anywhere given in the question that professional and dynamic are related to each other? No. If I'm not given that, it means it's an unrelated party transaction. So the question of a common control does not arise. Now, once it is a transaction between unrelated parties, the next thing which you need to zero down is decide that is this acquisition or a reverse acquisition? And the step number 1 has got a very vital role in terms of that. So let's do one thing. We can see that the purchase consideration is mainly in the form of shares. We can see that the purchase consideration is mainly in the form of shares. And I can also see one thing very clearly, that no new entity is created. We can very clearly see that no new entity is created as well. Now, if you remember, when I gave you the step number 1, these were the 2 crucial points that you had to identify. Did the new entity got created and what is the form of PC? We decided 3 inputs at that stage. So therefore, no new entity is created and the purchase consideration, you can say, is mainly in the form of shares. So what do you like to tell me? Am I supposed to calculate a percentage pre and a post business combination to understand did the company professional lose a control or not? Correct. So what we're going to do at this stage, we are going to do some small little calculations, see what is the status pre-business combination and see what is the status post-business combination, get the percentages. So can I say Professional Limited would of course be having a 100% stake. All the shareholders of Professional had all the shares of Professional. So the company was in complete control of the shareholders of Professional. Now I want to see, once Professional Limited issues the shares to Dynamic, I want to see that the percentage will definitely get diluted. But is it getting diluted to the extent that the control is gone or not? Let's, I think, go back. Let's first look at the balance sheet of the company and let's see what is the status of the number of shares. The equity shares of Dynamic is 100 each and the equity share of Professional is 10 rupees each. So which means this is coming to a total of 50 lakh shares because the shares is 10 each, and this is coming to a total of 4 lakh shares because the shares are 100 each. So this is the status of the number of shares of Professional as well as Dynamic Limited. Now, let's see further. So we're given that Professional acquired 70% shares of Dynamic and he said, I'll issue 1 share for every 2 shares in Dynamic. So I think we're ready to do some calculations now. So Professional Limited has got a total of 50 lakh shares. So Professional Limited has got a total of 50 lakh shares. And when they acquired the control over Dynamic, Dynamic had a total of 4 lakh shares and we acquired 70% of those shares. And we issued 1 share for every 2 shares. So can I say the total number of shares of Professional post the business combination will be this. So what I've done, I've taken the shares of Professional Limited pre-business combination. The company Dynamic had 4 lakh shares. Professional acquired 70% of these shares and issued 1 share for every 2 share held. So this is indirectly giving you the shares issued by Professional Limited to the shareholders of Dynamic. Mind the words. So can I say now we can see the percentage stake. We can see what is the stake of Professional Limited shareholders in the company. So 4 into 70%, that comes to 1.4. So 50 divided by 51.4, the percentage dilutes, but it comes to 97.3%. So can I say hence it is proven that the company Professional Limited percentage got diluted but the control is not lost. So can I now outrightly say that Professional Limited is both legal and accounting acquirer? Now let me tell you, these calculations which I've done are not given in the study mat, but I feel on a personal level that yes, if you make these calculations, you'll be very clear and decide that who is the accounting acquirer. I hope I stand very clear on that. Okay, so we can say in this particular case, since the percentage is merely got reduced to 97.3, so we can say the legal and the accounting acquirer is the same. So once you decide the legal and the accounting acquirer is same, we've reached the conclusion that the concept of acquisition accounting would apply in this case. Wow. So my step number 1 is done. You can see all the crucial learnings which you've done in each of these steps. I'm applying those crucial learnings in each and every step. Your focus needs to be very clear regarding the thought processes to be applied when you do the step number 1. Okay, so far so good. I hope, friends, you've understood the step number 1. I'm going a little slow as well, not very fast, so that you don't get, distracted on the, speed. So I'm going slow, but I'm giving you all the thought processes, combining it. Okay, now let's go to the step number 2. In terms of step number 2, we need to get the date of acquisition. And I think as far as the date of acquisition is concerned, we know that the date of acquisition ideally is always equal to the closing date. The closing date is when the purchase consideration is discharged. And the date of acquisition is when you get the control. We are not given any information which tells me that the control is preceding the date of the closing date. So I think in this case, we can conveniently consider 1st April X2 is the date of acquisition. That is the date when the control is coming in. I think step number 2 is pretty simple and straight. Now comes the step number 3. And in terms of step number 3, we've got 2 sub-steps. One is that you need to apply the deferred tax implications. One is we need to consider the deferred tax implications in this case. And then we're going to make a list of the net assets as well. Now, tax rate is very clearly stated in the question. And since the tax rate is very clearly stated in the question, you need to pick up all those assets and liability where the book value and the fair value is different, and then organize the data. So let's make a small little format organizing the information. So we'll take the names of those assets and liability, get the book value, get the tax base, get the temporary or taxable differences, whatever the case may be, and get the DTA or the DTL. So in this case, I will first take a column for particulars, getting the name of those assets and liability, get the carrying amount, get the tax base, get the temporary differences, identify is it taxable or is it deductible in nature, and get the DTL or the DTA as the case may be, which is applying the 30% tax rate which is given in the question. Okay, so now let's go back to the question. Look at the list. Though when we were reading the question, we very clearly identified the PPE is got a fair value, the contingent liability is got a fair value, but we just on a very safe side, go back and scrutinize the question again. So that's the balance sheet. So I think we can see the PPE is appearing at a book value 500. So I think the fair value which is given out here in point number B is supposed to be 350 lakhs. And the contingent liability is got a fair value which is to the extent of 5 lakhs. So I think there seems to be only two items. So we can fit them. So one is the property, plant, equipment, whose carrying amount is 500, but whose tax base is given to me, it's 350. So this difference of 150, taxable or deductible in nature, what do you say? The carrying amount is greater as compared to the, I think it's the other way around. Since the fair value is now 350, that is the carrying amount, and the book value becomes the tax base. So the tax base is greater as compared to the carrying amount. So is this taxable or is this deductible difference in nature?
Deductible.
Wonderful indeed. So I'm putting this as D, it's deductible. So this will lead to a DTA at the rate of 30%. Okay. Then the next item we've got is the contingent liability. And it has got a fair value that is 5 lakhs, but there is no tax base. And in this case, the carrying amount is more. So this leads to again DTA or a DTL. 30% would mean 1.5. So taxable or deductible in nature. It's a liability.
Deductible.
That's right. It's again deductible. So this will also lead to a DTA. So we can say the total DTA is 46.5. That takes care of my step number 3A, where we've compared all the assets and liability whose fair value, that is the carrying amount, is different from the tax base. Because the taxation authorities will give you a deduction based on the book values itself. Fair valuations are not considered in the calculations of taxation. They do not give you deduction based on the fair value. Okay, that's done. Now we're ready to go to step number 3B. So as I said, if you keep going systematically, it's going to be a very easy affair. So now we look at the list of net assets. And when you look at the step number 3B, your focus in the mind in this case should be, if there are any exceptions, I need to take care. Now, if you just try to look at the question once again, you can see the contingent liability is there, but there is no indemnification assets. I don't see any information regarding the other exceptions. Income tax is there, contingent liability is there, but I don't see anything else. I don't see any information about intangibles or any information about indemnification assets or employee benefits or leases, etc. So I think we can now consider the list of net assets and they need to be taken at a fair value. That's the important issue. So even the DTA, which you created in step number 3A, is going to be taken as a part of this list. So let's do one thing. Let's go back to the balance sheet. And we're going to pick up all the assets of Dynamic, and that will be taken at a fair value. So PPE is got a fair value 350. Investments is 100. So I think if you have your study material opened in front of you, I will just directly take the information and just fit in out here. So the first item which is given to me is PPE. That's got a fair value of 350. Then I've got investments. And I think the investments is to the extent of 100. I'm just taking the information from the balance sheet, and if there is any fair value, we'll take that. The next item is inventories. This is again taken at a book value because we are not given any fair value. So that is 150. So this is the only item which is taken at a fair value. The rest, all the fair value, book value seems to be the same. Then I am given trade receivables is 300. And then I am given cash and cash equivalents is 100. And then I'm also given the others, that is 230. The others is 230. Least we forget, let's take the DTA. That is what we have taken from step number 3A. That is always a part of this list. I think that's it on the asset side. I don't see that there's any other item. Then on the liabilities, we've got long-term borrowings. So we've got long-term borrowings. And that's again at a book value of 200. Then there is a long-term provisions, and that is to the extent of 70. Rest, nothing is given except contingent liability. Then there is an existing DTL to the extent of 35. So existing DTL is 35. Then there is a short-term borrowings of 150. Short-term borrowings of 150. And then there is a trades payable to the extent of 300. And I think least we forget there is a contingent liability whose fair value is to the extent of 5. So this contingent liability fair value is taken. So these are the two items, PPE and a contingent liability taken at a fair value. And this is the only exception which is available in the list. In this case, we are not given any other exceptions to the recognitions and the measurement principle. So that gives you the list of net assets. So the focus when you're creating the list of net assets is remember to take the DTA, DTL in step 3A and then consider those 8 exceptions. Take all the assets liability in the balance sheet at a fair value, incorporating those 8 exceptions which we did. Okay, so far so good. Let's get the net assets in this case. So let's take the total of the assets minus liability. So 350 plus 100, 150.
516.5.
Wonderful. So 516.5. Great. Okay, so far so good. So that makes it step number 3B. How are you finding this question? Easy or difficult? Say easy. Nobody's vouching for that. Isn't that easy? Say yes.
Yes, sir.
It is. I think if you keep the focus, I don't think so. It's very tough. Okay, now I think comes the very crucial step, that is the calculation or the purchase consideration. Now, when you calculate the purchase consideration, we made a list of 7 issues. So what I'm going to do, I'm going to write down those 7 issues, filter the question and see that, if those 7 issues are there, we'll just fit into that. So we need the purchase consideration. So in terms of the purchase consideration, the first is we need to take the fair value of the shares issued, because that is a base calculation as a part of the purchase consideration. We've issued the shares to the shareholders of Dynamic, and I think we just did that calculation. If you remember, there were a total of 5 lakh shares, and you can say we acquired 70% of these shares. It was 5 lakh shares, right?
No, sir. 4 lakh.
It was 4 lakhs, sorry. So there were total 4 lakh shares of Dynamic. We acquired 70% shares, issued 1 share for every 2 share. And I think we were given the fair value of the share in the additional information. Let's have a look. So it says that the fair value of the shares of Professional is 40 rupees per share. So when you take the fair value of the shares, so this is fair value of the shares issued. And that's a base calculation. So we get a total of 1.4 into 40. That comes to a total of 56 lakhs. Now we'll just write down the list of 7 issues which might be there. So they may be there in this question or not, but I think I still want to pen down those list of 7 issues to get the funders clear. So one is the deferred consideration, and one is the contingent consideration in the shareholders' capacity, then contingent consideration in the employee's capacity, then there is a transaction cost, and then we can consider number 5, that is share-based payment. Then there is PHI, previously held interest, and if there is any pre-existing relationship as well. So these are the list of 7 issues which we need to tackle in terms of the purchase consideration. Okay, so based on this now, we'll go back to the question and see those filter. I think the DC is what we identified at the very start. In the point number B, we decided that this 35 lakhs is the amount which is going to be paid irrespective. Because he says we're going to pay higher of 35 lakhs or 25% of the excess profits, and this is going to be paid 2 years later. So we have decided that this 35 lakhs is the DC, and there is no contingent consideration fair value given. And there was also a payment of 20 lakhs, which is CCE. So I think we can just come back on the data. So deferred considerations, we can pick up the data. So we're going to pay 35 lakhs. And I think we're already given the discounting rate is 10%. This payment is going to be given 2 years later. So we will discount this 35 lakhs over the period of 2 years at a 10% discounting rate given. So if we discount this, I think this comes to 28.93 approximately. The contingent consideration in shareholders' capacity, the fair value is not given, so we are not considering that. The contingent consideration employee capacity is not taken. The TC is neither given nor it is taken. Now comes the important issue. And there is no PHI, there is no pre-existing relationship as well. The only input is the share-based payments figure. Now let's go back and see the SBP details as well. So coming back to the point number D, where we are given the details on the share-based payment. So we can clearly see the information. The vesting period was supposed to be 4 years, and 2 years they've already served. And now the vesting period is reduced to 1 year from the date of acquisition. So can you tell me what is the total vesting period? The original vesting period was 4 years. But what is the total vesting period based on the changes made?
3.
That's right. So 2 years already elapsed and another 1 year is there. So we can say it becomes 3. And we need to consider the vesting period completed upon the total or original, whichever is greater. So we're going to take 2 by 4. Now we're given the fair value of the original award is 5 and fair value of the replaced award is 8. So you're going to take the pro rata of the original award. So let's go with the calculations in the share-based payments. So we can say in the share-based payments, 5 lakhs is the fair value of the original award. Vesting period completed is 4, original or total, whichever is greater. So that makes it a total of 2.5 lakhs. So we've taken the pro rata. the pro rata fair value. Okay, so I think this is done. The calculation of the purchase consideration is also taken care. So we add this up, and I think this is coming to 87.43, I guess.
Yes, sir.
Great. So the step number 4 is also done, the purchase consideration done. Now we go to step number 5, NCI, step number 6, goodwill, and then it's just an acquisition entry. So let's go to the step number 5. So in terms of the step number 5, when you're calculating the NCI, your focus comes that we need to consider the NCI either at a fair value or it is considered at PASNA. In the entire input in the question, nowhere am I given that there is any fair value of the NCI. So by default, the NCI will be taken at PASNA if the question is silent. Because if it is at a fair value, he will also give you the fair value of the shares of the acquiring company. In the absence, it is implied that we're using proportionate share in the net assets of the company. And when you consider the proportionate share in the net assets of the company, you got to consider the net assets in the step number 3B. So let's see what is the status of the net assets in step number 3B. And this amount which is there in step number 3B is going to be multiplied with the percentage which is held by NCI. That's supposed to be 30% because 70% is held by the investor, that is professional. The remaining 30% is with the NCI. So what was my net assets in step 3B? 516.5. So we take this 516.5 into 30%. That's going to give us the NCI figure as well. That works out at 154.95 lakhs. Great. Step number 5 is also done. Now we're going to go to the step number 6, which is goodwill, though it can also be obtained as a balancing figure in the entry, but let's compute it. So we go to the next one, that is step number 6, and that is the calculation of the goodwill. And in terms of the goodwill, we know it's a set calculations. You just need to add the amount of purchase consideration and the NCI. And you compare the sum total of this versus the net assets. And you will be able to get the amount of goodwill or the bargain purchase gain. It's just a plus minus calculations. So the purchase consideration was, I guess, 87.43. The NCI is 154.95 and the net assets is 516.5. So I think we're getting a bargain purchase gain that is a capital reserve. So let's see the amount of capital reserve in this case. Okay, I guess I am asked a question. Sir, here the fair value is given 40. That fair value 40 is the fair value of professional limited company. If you need the NCI at a fair value, you need the fair value of dynamic shares. So if you're thinking that this fair value per share is 40, that's not for the subsidiary company, that's for the parent company. So you can't take that into account, right? Okay, that's great. So now let's see what is the capital reserve. I think it's coming to 274.12. That is the capital reserve in this case. Okay, that's wonderful indeed. So I think my calculations on the capital reserve is also done. Now we are ready to make the acquisition entry. Now, the acquisition entry is nothing but arranging all this information at a single place in the entry. So let's look at the step number 7. But that's not the requirement of the question. That's not the requirement of the question. We have to make a consolidated balance sheet, but let's look at the acquisition entry at this stage. Now, let's first organize the entry. Then I think we'll work upon the consolidated balance sheet, give you the linkage in terms of 103 and 110. Okay. So first of all, I think let's take the net assets all together. The net assets will get a debit, and that's 516.5. Then there is a purchase consideration which gets a credit. That is, I think, 87.43. Then there is an NCI which gets a credit. I think that's 154.95. And there is a capital reserve which gets a credit. And that's, I think, 274.12. See, is this journal entry tallied or not? Technically, it should be, because this is what we have done just now. We took the net assets, we took the PC NCI compared to the net assets. But still, let me ask you, is the entry tallied? It should, I guess, logically,
Yes,
it should definitely tally. Yes, great. So the question is not complete. The requirement of the question is done. It is focusing on the consolidated balance sheet. Now it's time to give you the connect between Index 103 and Index 110. Rather, I would say 3 standard 27, 103 and 110. Now hear this very carefully. So I'm just going to give you some inputs to understand this. Let's imagine this is a balance sheet T-shape, and let's imagine this is a balance sheet T-shape. Now, Professional Limited is required to make a separate financial statements. Professional Limited is required to make a separate financial statements, and it has got a control over dynamic. So he's also required to make a consolidated financial statements, balance sheet in this case. Now, when Professional Limited acquired the stake in Dynamic, can I say he would have done the entry, investment gets a debit, and whatever purchase consideration is paid, the forms of payments will get a credit. Please mind this carefully. I'm looking at the acquisition of 70% shares in Dynamic. And for this, you're passing the entry in the individual books of accounts, in the separate financial statements of Professional. And when you're putting this entry, let me tell you, you are indirectly applying Index 27. And that is on separate financial statements, that you're capturing the investment acquisition in the books of Professional Limited. You're putting a normal entry for acquisition of the investment. Since this investment in equity share is a related party investments, financial instrument standards would not apply. And Index 27 would apply, which tells you to capture this investment at a cost or a fair value, which is your choice. We are taking it at the cost of acquisition. Now, this investment is recorded at 87.43. And correspondingly, the PC is paid in the form of equity shares. So we'll give a credit to the equity shares, and the excess will be the premium. Now, if you go back on the calculation of the purchase consideration, we can get some details out here. So this is a total of 1.4 lakh shares with a face value 10, but issued at 40. Which means that there is a 30 rupees premium on every share. So we issued a total of 1.4 lakh shares with a face value 10 rupees. So we can fit this out here. So this comes to, you can say 1.4 lakh shares with a face value 10, and that remaining 30 is the premium. So this comes to 14, and this comes to 42. So this is the discharge of the purchase consideration by way of issue of equity shares. Then there is a deferred consideration. So let's give a credit to the deferred consideration. The deferred consideration in this case is to the extent of 35. No, it was discounted, sorry. So I think that was 28.93, I guess. So let's go back to the calculations of the purchase consideration. So we've taken the DC 28.93, and then there is an SBP payment. And if you remember, this is going to be created as an SBP reserve in the books of Professional Limited because he is replacing a mandatory replacement of the share-based payment. So this payment of 2.5 is going to be captured as SBP reserve. So this is the journal entry which you are passing in the books of Professional Limited, that is standalone, or you can say separate financial statements. Did you get the connect, I guess? Did you
Yes,
get the
sir.
connect? This is the separate financials. Great. So this is the separate financial statements, which means in the balance sheet, I would show the investments. This is the investments in Dynamic Limited. And this will appear at 87.43 with all other corresponding changes incorporated. You will increase the equity share capital to the extent of 14. And in the other equity, you will include the security premium that is to the extent of 42. And you will include the amount of SBP reserve in other equity, and that is to the extent of 2.5. So you can say the share capital gets incorporated in the share capital, the premium in the other equity, the SBP reserve in other equity, and the deferred consideration will be captured separately at 28.93. This is how the separate financial statements will look like. Now see what you're doing. Now what we're doing is we are putting an entry under Index 103. We are putting an entry under Index 103. So when you're putting an entry in Index 103, you said, let's capture the net assets. And that is to the extent of 516.5. And let's give a credit to the investment. Let's give a credit to the NCI, and let's get a capital reserve. The investment, NCI, and the capital reserve gets a credit. So you put the entry under Index 103 on the date of acquisition. The net assets gets captured at a fair value. The investment is 87.43. The NCI is 154.95. And the capital reserve is to the extent of 274.12. This is the entry which we have done under Index 103. Now watch this carefully. In the Index 27 balance sheet, if you incorporate the Index 103 balance sheet, trust me, the answer is consolidated balance sheet under Index 110. So you can say if you want to make a consolidated balance sheet under Index 110, which is on the date of acquisition. So what do you need to do? This is the financial statements, separate financials, incorporate the Index 103 entry, and the byproduct is the consolidated balance sheet. So indirectly, what is going to happen? Watch this. Indirectly, what is happening? The investment is given a credit, it disappears. And you can say what gets incorporated in the balance sheet is the net assets. Investment is gone and the net asset gets incorporated. You're basically consolidating the subsidiary. So this investment gets incorporated. The NCI gets incorporated, 154.95. The capital reserve gets incorporated, 274.12. And of course, all these informations would of course continue. All this information would of course continue in the balance sheet itself. You will see later when we come to Index 110, you will see consolidation is nothing but removal of the investments and the insertion of the net assets, the NCI, and the capital reserve. Every time we'll see the consolidation, which you'll get the connects later when I come to the consolidation in detail. What is the difference between a separate and a consolidated financials is you remove the investment from the balance sheet, separate financials, and instead you introduce the 100% net assets, you introduce the NCI, and you introduce the goodwill or the capital reserve. And this makes it a consolidated financial statements on the date of acquisition. In other words, we can say, what are we indirectly doing? Index 103 is you can say a bridge You can say Ind AS 103 is like a bridge between the separate and the consolidated financial statements on the date of acquisition. This entry of 103 is done on the acquisition date to produce the consolidated financial statements on the date of acquisition. Thereafter, when you prepare a consolidated balance sheet year by year, you follow the concept of Ind AS 110. So 103 only acts a one-time bridge between the separate financial statements under 27 and the consolidated financial statements, which is under 110 only on the date of acquisition. I hope, friends, I stand very clear on my thoughts that what is the connect between 27, 103 and 110. So far, so good, I guess. Okay, that's wonderful indeed. So I think we got the connects on this. Now we're ready to make a consolidated balance sheet as well. Now, in order to make because the question is asking you to make an opening consolidated balance sheet. So what I'm going to do, I'll pick up the data from the balance sheet of professional, incorporate this entry and produce a consolidated balance sheet on 1st April. Let's do that. So now we are trying to fulfill the requirement of the question. We are making a consolidated balance sheet on 1st April X2 of Professional Limited. So I think let's do one thing. I think first of all, copy the structure from the question itself, incorporate the acquisition entry and get the results. So for this purpose, let's create some interesting chart. And I'm just going to first copy the balance sheet. So I'll take the balance sheet of professional, incorporate the entry and get the consolidation. So this is the separate financial statements of Professional Limited. This is the Ind AS 103 entry incorporated. And we get the consolidated financial statements on 1st April X2. That is how we're going to get the consolidation done. Now we'll first copy the balance sheet of professional from the question. So let me begin with the NCA. So we've got a property, plant, equipment. So I'm just copying the balance sheet as it is. The PPE is appearing to the extent of 300. And then I am given the investments. Least I forget, let me just at least create a column. No, there's no goodwill, there's capital reserve, so we can forget about goodwill. Then there is investments, that is 400. This is the balance sheet of professional, which I'm copying as it is from the question itself. Then I am given the current assets, that is inventories are 250. So we're given the inventory is to the extent of 250. Then there is next item, trade receivables, cash and cash equivalents. So trade receivable is to the extent of 450, cash and cash equivalents is 200. And then there is others, that is 400. So let me not mess the balance sheet out here. This becomes the asset side of the balance sheet. So this is my asset side of the balance sheet. Same way, I'm going to create the liability side as well. So we'll take those 4 columns. One is the liability portion. And then we are also looking at separate 103 and consolidation. So this is the separate financials. This is the Ind AS 103 entry. And this is supposed to be the consolidated financial statements. Let's consider the equity and the liability section now. So in the equity section, we are going to consider a couple of items, equity share capital, then there is other equity, and the NCI will also be a part of the equity section itself. When you show the equity, NCI is a part of the equity section. And then we are given the non-current liabilities. And that's to the extent of, let me first take the data. The share capital is 500. And the other equity is given 810. And the NCI, of course, is not in the existing balance sheet. Then we're given the long-term borrowings and the long-term provisions. The long-term borrowings is to the extent of 250, and the long-term provisions is to the extent of 50. And then there is a deferred tax liability. The deferred tax liability is 40. So we'll need a DTA also later. And then there is a current liabilities, and the current liabilities we're given short-term borrowings as well as the trades payable. So that is to the extent of 100 and 250. So this gives me the status of the balance sheet. Okay, so I guess let's begin with the journey. So I've just copied the balance sheet of professional from the question. I'm now just going to put in the entry of 103 in between. So let's, I think, add the inputs from the journal entry acquisition accounting. I think PPE was taken at 350. You can just look at the step number 3B. You can look at the step number 3B because the breakup of all the net assets is given in step number 3B. So pick up all the data. So that is 350. Investments, I guess, is 100. Then inventory in the entry, I think, is 150. And then there is a trade receivable that's, I think, 300. Then there is a cash and cash equivalents of 100. And then this is 230. Then I think there is a DTA. I think I'll take the DTA out here. That was, I guess, 46.5. I think that's it on the asset side. So this is done. Then on the liability front. So liability fronts, we had long-term borrowings is 200. Provisions is 70. And then there was a figure of a DTL 35. So DTL is supposed to be 35. That was a deferred tax liability. Then short-term borrowings is 150. And then there is trades payable 300. And I think least we forget there was a contingent liability. I'm adding that contingent liability as a part of the trades payable in this case. Though you can create a separate heading as well. So this is the net assets done. We're just incorporating that 103 entry. So net assets done. Next. The next is we need to consider the calculations as far as equity share capital is concerned. So equity share capital went up by, I guess, how much? 14. And the security premium was 42. And then there was SBP reserve, that is 2.5, all a part of the other equity. Then there is an NCI. NCI was how much? 274.12. So we add the nth figure of 274.12. This is capital reserve. This was 274.12 was the capital reserve. So 274.12 capital reserve. And the NCI, I think, was 154.95. So I guess the entire entry is incorporated. Net assets done, goodwill done, NCI done, capital reserve done. Everything is done. Now we can get the consolidated financials. So let's make the consolidated financials in this case. So the equity share capital is 514. Other equity, we just need to add all this. 810 plus 42 plus 2.5 and 274.12. This comes to 1128.62. Then NCI is 154.95. Then long-term borrowings is 450. We're just adding the figures. Then there is long-term provisions 120. Then DTL is 75. You can net off the DTL DTA as well, giving a note. Then short-term borrowings is 250. And the trades payable is 555. The trades payable is supposed to be 555. So I think this is all on the liability side, 514,1128.62. This is, I think, coming to 3247.57. So this is coming to 3247.57 is the total. Now let's go back on the asset side as well. This is 650 and this is 500. This is 46.5. This is 400 and this is 750. This is 300 and 630. Let's, I think, add this up as well. Three to 76.5. There is some difference coming in. Did I miss out anything? I think the deferred consideration is missing, right? There was a DC which is missing. So DC should also be added out here. I'm just putting the deferred consideration. And the deferred consideration was, I think, 28.93. So that is 28.93. I think I missed that out. Yes, that's the exact difference. So my balance sheet is tallied at this stage. The total of the balance sheet is coming to 650, 546.5. This is coming to 3276.5. This is coming to 3276.5. Right, so the consolidated balance sheet is ready. You can call this as the opening consolidated balance sheet, which was created on the basis of the separate financials, adding the Ind AS 103 acquisition entry and the product. The result is the consolidated balance sheet. Right, friends, I hope you got the entire connect in terms of things. Taken us a good time to do this question, but I think it was worth it. Because now you can see the applications of all the 7 steps, including the impact of making a consolidated balance sheet. Before we go further, let's, I think, get your comfort zones on a scale of 10 regarding the application of this 7-step model to a larger question. Because now I'm going to go to reverse acquisition. This is acquisition accounting. Now I'm going to go to the reverse acquisition. That's great. 9. That's brilliant indeed. And we got another score, 9.5. That's great. 10 out of 10. That's superb. Wonderful indeed. Okay, so far so good. So that's great. Now, acquisition accounting, 7-step model done. Now we are going to go to reverse acquisition. In reverse acquisition, I'm going to do 2 questions with you. When it comes to reverse acquisition, I'm going to do 2 questions with you. One is a case where new entity is not created. That's one. And one is a case where a new entity is created. The principles we have done in acquisition accounting is equally applicable, except the calculations of the purchase consideration. So how do you tackle the purchase consideration in a reverse acquisition? That I'll explain with a practical illustration itself. So let's, I think, go to the study material. And there is another question, which is, I think, given at the back, which is dealing with the concept of reverse acquisition. Yes. So let's have a look at this. This is question number 2 at the back on the test your knowledge. So I'm just sharing that question. I'll just zoom it across to you. Question number 2 at your test your knowledge in the end. I hope, friends, that is visible to you. And then there is just one liner requirements out here. So we don't need much on this. This is just one liner asking us the requirement. So this would, of course, be very much visible. So can you see this portion of the question, I guess? Visible to you? Question number 2?
Yes, yes.
Oh, great. Now, let's, I think, read this question. So we are now on the second area of 103, that is on reverse acquisition. And we are going to deal with this. Okay, in the meantime, please let me also tell you, as I said last time, I'm going to extend the class today. So I hope you remember, because I'm going to go beyond 10, almost around 10:30 or so. I hope that's fine. Okay, so now let's read the question number 2. The focus is on the reverse acquisition, though we need to identify that is it a case of reverse acquisition or not. That needs to be identified in the question. Let's read. It says on 31st December X1, entity A issues 2.5 shares in exchange for 8 ordinary shares of B. All the entity shareholders exchange the shares in entity B. So when it says all of them exchange the shares, that means there is no NCI. There is a 100% share exchange. Every shareholder accepted the offer. Therefore, entity A issues 150 ordinary shares in exchange for all the 60 ordinary shares of B. I think if you go back and look at the balance sheet as well, we can clearly see that there are 100 shares of A and there are 60 shares in B. Now, we told the shareholders of B that we will give you 2.5 shares for every 1 share. That makes it a total of 150 share. So he's already applied the exchange ratio and giving you the data that A will issue 150 shares for 60 shares in B. Then he says the fair value of each ordinary share of B is 40. The fair value of B is given. And the quoted market price of A is also given. So we're given the fair value of A and we're given the fair value of B, both the companies. Then he says the fair value of entity A, the fair value of entity A. Now, as you read the question, the thought should start coming to your mind as well. He tells me that A acquired the business of B, and on the very apparent front, it seems that B is the acquiree. But when it comes to the net assets, he starts giving me the fair value of A. Is that indirectly giving me a hint that this is a reverse acquisition? I would say yes. Because in step number 3B, when you prepare a list of net assets, that is a list of net assets of the accounting acquiree. And when he's trying to tell me that A acquired the business of B, but then he tells me the fair value of A's net assets, I think it's indirectly telling me that this is going to be a reverse acquisition. A very subtle hint, but of course a hint. So he says the fair value of A's assets and liabilities are same as the carrying amount, except the fair value of the non-current assets is given. So everything has got the same book value, fair value, except the, you can say, non-current assets. The balance sheet of A and B immediately before the business combination is given. So this is without incorporating the acquisition accounting. Now you can see very clearly he says he is the legal parent or the accounting acquiree. He is the legal subsidiary or the accounting acquirer. Now that is indirectly telling you point blank that this is a reverse acquisition. But I think I want to still work out. I will not accept the information, but for understanding purposes, I'm going to explain you also that why is this a reverse acquisition. I know it is very clearly stated in the question it's a reverse acquisition, but we're going to still apply our thoughts. Then he says in the end, assume that B's earning for the annual period is 600 and the consolidated earnings are 800. Assume there is no change in the number of ordinary shares issued during the annual period. And then it says even on the acquisition, that is the status of the number of shares given. And the requirement of the question is calculate the fair value of the consideration transferred, that is PC, and measure the goodwill and prepare the consolidated balance sheet on December X1. So the focus is on the PC, the focus is on the goodwill, and the focus is on the consolidated balance sheet as well. So you've seen the complete 7 steps with a consolidated balance sheet and acquisition. Now you're going to see 6 steps. Instead of 7, we're going to do 6 steps and make a consolidated balance sheet. We're not going to put entry as far as reverse acquisition is concerned, because there are some considerations for which entries will confuse us. So what we're going to do in terms of reverse acquisition, 6 steps out of those 7, and then the consolidated balance sheet as well. Let's begin the journey. So this is question number 2. This is the question number 2. Test your knowledge at the end. We're going to apply our 7 steps in this particular case. Let's begin the journey. So we've got the step number 1. And in terms of step number 1, now let me also remind you, this is a question where there is no new entity created. This is a question where there is no new entity created. We're going to do a question after this where a new entity got created. So this is step number 1. We want to determine the accounting acquirer. Though we are very clearly given that B is the accounting acquirer, but I want to still give you the calculations and we want to understand this in a detail. How would we identify that who is supposed to be the accounting acquirer? Now let's get the focus very clear that the purchase consideration is in shares. The purchase consideration is mainly in shares. That is one focus point. And we can see that no new entity is created. No new entity is created. So we can say in this case, we need to again evaluate, since the purchase consideration is mainly in shares and no new entity is created, it is similar to the question of professional and dynamic. It is similar to the facts of professional and dynamic. In professional dynamic, the percentage got diluted, but the control was not lost. Now we need to see the same calculations out here. So we're going to do some workings. We're going to see the status pre and post business combination. So let's see the percentages pre business combination and let's see the percentages post business combination. Let's now consider the number of shares in the balance sheet of the company. Now, A has got 100 shares and B has got 60 shares in the company. So we're going to pick up the number of shares. So this company had a total of 100 shares. This company B, I think let's not keep the data here. So let's put it out here. So we can say that company A and B, they've got 100 shares and they've got 60 shares. This is the number of shares in the company. Now we want to see the pre-business combination and the post-business combination. And you can see my thought process in terms of solving the question is exactly what we did earlier. So we can say the shareholders of A had 100% shares in the entity A. So the shareholders were in full control of entity A. Now entity A has got 100 shares and as per the instructions we are given that we issued 150 shares to the shareholders of B. Because they were given 2.5 shares for every 1 share, 60 into 2.5, we've seen 150. So A issues to the shareholders of B a total of 150 shares. The total capital of A becomes 250. Now the shareholders of A have got 100 shares out of 250. So this percentage comes to 40%. Can I say A after the issuance of shares? His control is gone. The percentage is diluted to an extent that his control is gone. So can I say if this is the case that the control is gone, can we outrightly say that in this case the legal and the accounting acquirer is not the same? It is undoubtedly a case of reverse acquisition. So we can say entity B is the accounting acquirer in this case. Because the control is moved on from entity A to the entity B, so we can say B is the accounting acquirer. Now, let me also tell you something important. At times in the examination, you will feel, what's the good point of doing this? Let me save my time. You will say that, if the question is already telling me that B is the accounting acquirer, I shouldn't save time in the examination. Why I need to do all these calculations except, what is given in the question. Agreed, but this percentage which B is getting and A is getting post-business combination is important to calculate the PC. So I would say that this percentage calculation should be done even if the question is very clearly telling you who is the accounting acquirer. Because in the calculations of my PC, I need this data. I need this data. Okay, so this is step one. Now let's go to the step number two, which you'll see very shortly why I'll need this data. Then we come to the step number two, which is getting the date of acquisition. And I think that's not a very technical issue. The date of acquisition is very clearly stated in the question, so we can directly pick up the data. It's on December X1 that all this deal happened. So we can say the date of acquisition is December X1. I am nowhere given any kind of information regarding the closing date and then to be compared with the date when the control is transferred. There is no preceding concept. The acquisition date is simply the date when the PC is paid. Then we go on to the step number three. And in this case, can I say step number three, that is deferred tax is not required, correct? Nowhere I am given in the question any information on a tax rate. Since no information on a tax rate is given, we don't need to apply any step number 3A in this case. We can now directly go to the step number 3B, get the list of the net assets. So we go to the step number 3B and get the list of net assets in this case. Now, when you get the list of the net assets, one focus needs to be very, very clear. When I say the list of the net assets, we always need to consider the net assets of the accounting acquiree. So remember, when you say accounting acquiree, A is the legal acquirer, but he is the accounting acquiree. So when you go to take the net assets in this case, the focus point is that we need the net assets of the accounting acquiree. So when you need to consider the accounting acquiree, that in this case is A. And that was the subtle hint. The examiner was giving you the fair value of the net assets of A because it was a reverse acquisition and therefore A was the accounting acquiree. So he already gave you the fair values of the accounting acquiree in this case. Now, let's, I think, go back to the data. So I think the question must be there in front of you, study material, but I'm just going to pick up one information. So we'll move asset by asset. The only fair value of the non-current assets is given 1500. Rest all the book values and fair values are common. So let's take the non-current assets, that's 1500. So I'll just keep the balance sheet in front of me. You can also open the balance sheet. And we can just pick up the information in this case. So rest all the book values, everything is exactly the same. So in this particular case, the current assets is appearing at 500, the book value. I think that's it. There is no other assets in the balance sheet. Current liabilities is to the extent of 300. And then there is a non-current liabilities as well. And that's to the extent of 400. That's it. There are no exception list. Nothing is given. So there's nothing in terms of step number 3B. No exceptions, nothing. So we just take the net assets. So that is 2000 minus 700. So this is, I think, works out at 1300. Did you see any kind of change so far? Or do you think the things are exactly similar so far? Any difference between acquisition accounting and reverse acquisition, except that the percentages decided that A is the acquiree and B is the acquirer. But otherwise, other than that, everything works exactly the same. Okay, now comes the crucial step. Now, watch this carefully because this is a crucial step indeed. So we are on step number 4, which is on the calculation of the purchase consideration. Now watch this carefully because many times people tend to get confused on this area of calculation. Because I think reverse acquisition involves this crucial step. I think this is the only crucial step where you're clear, then I think life is simple. Now, first of all, what we need to understand in this case is when it is a reverse acquisition, the consideration is paid by A, but we need to consider in a reverse acquisition if the consideration was paid by B. So get one thing very clear. Your very first focus is that A paid the PC. But I don't need to consider what A paid. In a reverse acquisition, A paid the PC, but I'm not concerned with what A paid. I need to work out what B would have paid. Mind the words. So we need to work upon what B would have paid. So this is one focus point. So when you calculate the purchase consideration, you need to consider what B would have paid. So in a reverse acquisition, you don't need to consider what A paid. You need to consider if B would have paid, but on what basis? On what basis? So when you say what B would have paid, we can say on the basis, we need to calculate this on the basis that B wanted to achieve a 60% stake. This is on the assumption that he wanted to achieve a 60% stake. Now you will say, where do you get that 60%? Remember, we did the calculations in step number 1 that A gets a 40% stake in the business combination, post-business combination. If the shareholders of A are getting a 40% stake in the post-business combination, then the shareholders of B have got a 60%. That means the deal was structured in such a way, mind the words, the deal was structured in such a way that B always wanted that he should get a 60% stake in the post-business combination. So, therefore, this 40% becomes important because without this 40%, you cannot get that what B wants to achieve. So the first thing what you need to do is sit down and calculate very carefully that I want to calculate what B would have paid. So we need to understand that in a reverse acquisition, we need to see what B would have paid because he never paid anything. It was paid by A. So we will calculate what B would have paid on the basis that B wanted to achieve a 60% stake, then what he would have paid. Now let's look at the stake of the company B Limited. Can I say B Limited has got 60 shares and let's say he would have issued X number of shares to the shareholders of A. So we're saying that B has got 60 shares in his company and let's say he would have given X number of shares to the shareholders, then this would have been the total capital of B post-business combination. He would have issued the shares in such a way to maintain a 60% stake in the company. Get this again very straight. The number of shares in B is 60, and if B would have issued X number of shares to the shareholders of A such that he wanted to maintain a 60% stake, get how many shares B would have issued in order to maintain that 60% stake.
40.
40. I hope, friends, you got the concept very clear that in a reverse acquisition, what is the thought to be applied? That you need to consider if B had given the consideration in order to maintain the same percentage which he is achieving in a reverse acquisition, he would have given 40 shares to the shareholders of A. So now we can calculate the purchase consideration. So we can say the purchase consideration is B would have issued 40 shares in his own company. And let's multiply this with the fair value per share. And I think that is already given in the question. And that is already given in the question that the fair value of the shares of B, it says the fair value of B shares is 40. So we can see the fair value of the shares is supposed to be 40. So my purchase consideration works out at 1600. I guess if this is clear, I'm going to give you something more. And I have to give you something more, but I hope this is absolutely clear. Correct? Did you get the process of calculating the purchase consideration?
Yes,
Super.
sir.
Wonderful indeed. So now on this basis, we're going to take the journey forward. Now, watch this carefully. There is something which is given in the standard now. The standard says that when your purchase consideration is only in shares, I did not say mainly. I said the standard says when the purchase consideration is only in shares. If your purchase consideration is only in shares, Now, in this particular question, we can see that the purchase consideration is definitely only in shares. In this case, the purchase consideration is not what you would have paid, but you need to consider by paying this, what did you get? Mind the words. The standard says if the purchase consideration is only in terms of share. If the purchase consideration is only in terms of shares, you don't need to see what B would have paid. You should see that by paying this, what does he get? So the PC is the fair value of what you receive, not the fair value of what you pay. So the standard says this is, you can say the fair value of what would have been issued. What would have been issued. So they say that don't consider this as a PC. When the PC is only in shares, instead of getting what would have been issued, you should consider the fair value of what would have been received. The fair value of what would have been received. Now you would say, what does this mean? What is B Limited going to get? If he issues these shares, what is he going to get in return? I'll explain. Can I say if B would have issued these shares to the shareholders of A, he would have got a control over the business of A. He would have got a control over those 100 shares of A. So when I say what would have been received, we can say he would have got a control over the 100 shares of A. He would have got the control over the 100 shares of A, and the fair value of the shares of A is 16 rupees, and this works out at 1600. Sir, but you can notice one thing. You can say that this is also 1600 and this is also 1600. The fair value of what would have been given and the fair value of what is received is equal. You will say the fair value of what is given and the fair value of what you would have received. By issuing the shares to the shareholders of A Limited, you would have got the control of the company of A, and by getting a control, you would have got a control of 100 shares of A into the fair value shares of A, and they are the same. I'll tell you the reason why they are same. The share price of the company A is 40, B is 40, and the share price of the other company is 16, and 40 by 16, it comes to 2.5. The exchange ratio is 2.5. Since the exchange ratio is based on the fair value of the shares, whether you consider the fair value of what would have been given or you calculate the fair value of what would have been acquired, the results is going to be absolutely same. Did you get my point?
Yes, sir.
Wonderful indeed. But you need to show both the calculations to the examiner. You need to first show the calculation that this is the fair value of what would have been given if B wanted to achieve this particular percentage. And then you also tell the examiner that if the PC is only in terms of shares, the more appropriate consideration calculation is the fair value of what would have been acquired. So we will say that by giving the shares to the shareholders of A, B will get a control over the 100 shares of A into the fair value shares of A, and you get the same purchase consideration. That is the most crucial aspect. That is step number 4. Now let's go to the step number 5.
Sir, if fair value is not based on exchange ratio,
Okay, if you mean to say that the
so
PC
PC
is
is
not just in
different.
shares.
No, sir, PC is different in both. So what
Then this
PC
is the answer. Then this is the answer. The
PC is
fair value
taken?
of what will be received, this is the PC then.
Okay.
Correct. Okay, now we come to the next step, and that is the step number 5, which is on the NCI. And in this case, there is no NCI because we've clearly seen that all the shareholders accepted the offer. So in this particular case, there is no NCI. Then we go on to the step number 6, and that is on the goodwill or the bargain purchase gain calculations. And this is going to be simple and straight. We just consider the sum total of the PC, NCI, compare it with the net assets. So just put in the data. So we take the purchase consideration, add the NCI, compare it with the net assets, and we will be able to get the goodwill or the capital reserve in this case. So my PC, I guess, is 1600. There is no NCI. I think net assets was 1300. So I think we're getting a goodwill to the extent of 300 in this case. Right, so we're not applying the step number 7 in this case. As I said, in terms of reverse acquisitions, we are only doing the 6th step. Don't put the journal entry. Now, the focus is to make a consolidated balance sheet. The focus is in the question to make a consolidated balance sheet. And let me give you some insights now. What do you think? Since the focus is to make a consolidated balance sheet, we need to understand one thing very clearly. It is a reverse acquisition, but at the end of the day, the legal acquirer is A. So the consolidated balance sheet is going to be presented by A because that's the legal requirement. But we can see that in substance, he is not the acquirer. Therefore, our accounting is working on the substance over the legal form. So in this particular case, the liability to present the consolidated balance sheet lies upon A, who is supposed to be the legal acquirer. The consolidated balance sheet is going to be presented by, you can say, the legal acquirer. So there are few things which you need to keep in mind. And let's, I think, come to those particular points. Number one, when you consider the consolidated balance sheet and you take the assets and liability, so what I will do, I will take the book value of the accounting acquirer. I will take the book value of the accounting acquirer, and I will take the fair value of the accounting acquiree. So when you go to make the consolidated balance sheet, the one important consideration is that you take the assets and liabilities, book value for the acquiree accounting, and fair value for the accounting acquirer. That's one. The second input, what you need to consider in this case is when you consider the equity share capital. When you consider the equity share capital, now there are two inputs. One is the number and one is the value. One is the number and what is the value. Now, when you consider the equity share capital in the consolidated balance sheet, we are going to consider the number. The number will be based on A, that is the legal acquirer. The number of shares to be presented in the balance sheet is the shares from the point of view of the legal acquirer who is presenting a consolidated balance sheet. But as far as the value is concerned, this will be from the point of view of B, who is the accounting acquirer. That's it. So you just need to keep these two crucial aspects into account. That when you're going to present the consolidated balance sheet, fair value of the accounting acquiree, and when you present the equity share capital number from the point of view of the company, who is the legal acquirer, because he is presenting the consolidated balance sheet, but accounting is being done on the basis of substance over legal form. But the values will be in accordance with the accounting acquirer itself. Let's now apply this and get the consolidated balance sheet in this particular case. So let's look at the consolidated balance sheet, which is being presented by entity A, because he is the legal acquirer. So he is going to present this entry. He's going to present the consolidated financials. So let's do one thing. We are just going to pick up the information. So let me just organize the data in a columnar form. We'll take the inputs, name of the asset liability. We've got A, we've got B, and the console. So we'll take the data for A and B and get the consolidated balance sheet in this case. So let's first of all take the item by item. We'll just pick up the item by item and fit it out here. So to begin with, first of all, on the current assets. I think in the balance sheet we're given current, but I think I'll take non-current first. So let's take the non-current assets. So remember, A, we are going to consider fair value, and B, we're going to consider the book value. So non-current assets of A, I guess, was 1500. And as far as B is concerned, we're taking the book value, that is 700. So this works out at 2200. And I think least we forget, let's take the goodwill. I guess the goodwill we got was 300. And then we consider the current assets. The current assets is supposed to be 500 and 700. So that works out at 1200. And I think that's it on the asset side of the balance sheet. So my balance sheet asset side, I guess, is done.
Sir,
Non-current asset is
3,000 non-current assets.
Oh, sorry. My bad luck. So this is 3,000. So this is going to be 3,000. That works out at 4,500. So I think this is 6,000, I guess. So this is the asset side done. Then we go on to the
Non-current
liability
asset
side.
for A is equal to 1,300. Na?
Fair value.
Okay.
So then we go on to the liability side. So we've got equity and liability. So let's take the equity and liability. So here when we consider the equity share capital, number would be based on A or B. Number on the basis of legal acquirer A. So A has got a total number of shares in the balance sheet, that's 100, and he issued a total of 150 shares. But we'll consider the value based on B. So the share capital of B is appearing to the extent of 600, and to this we add the PC that was 1600. So I think this works out at 2200. So this is from the point of view of A, and this is from the point of view of B. The number is A and the value is B. And then let's consider the retained earnings. So retained earnings will be only for the company B, and that's to the extent of 1400. And there is no NCI, and we're just given the non-current liabilities and the current liabilities. They are all at a book value. So non-current liabilities is 400 and 1100. That works out at 1500. And the current liabilities are 300 and 600. And that works out at 900. So let's see, is the balance sheet agreed or not? So I think that's 36 and
Yes, 6,000.
yes, 6,000. So that is the total of the balance sheet. So this gives me the balance sheet of the company A, who is the legal acquirer, because liability to present the consolidated balance sheet, of course, lies on the legal acquirer itself. Great. So far, so good. So we have done the input in terms of, we've done the inputs in terms of reverse acquisition, where a new entity is not created. Now my focus is going to be on a reverse acquisition when a new entity is created. We want to get that inputs clear. But I think before that, we need to give you a break. I'm sure you need one, because today I'm also going to extend the class a bit. As I said, I'll need some time. So may not be exactly 10:30, but I think at least around 20 minutes, 25 minutes more, so that I can finish my entire portion on the business combination. First, we'll do a question on the business combination reverse acquisition, new entity created. Then we'll come to our discussions on the common control, which is very easy. We'll understand what is the accounting, and we'll do practical illustration on that. But I think first, let's give you a break, 10, 12 minutes, and then we can commence back. Please enjoy your break. Okay, I think I'm getting a question. So can you please explain again the part that would have been given? Why is this kind of mix and match in the consolidated balance sheet in reverse? Okay, so I think let me explain this input in terms of the purchase consideration, as you said. In terms of the purchase consideration, if you remember, Ind AS 16, that is PPE. In terms of PPE, when there is an exchange of assets, you would recall that there are two concepts. One is that you consider the fair value of what is given. That, when you're acquiring an asset, you consider the fair value of what is given. And we also consider the fair value of what is acquired, whichever is more reliable in nature. That's what, Index 16 tells you. So there are always two aspects of the deal. And the two aspects of the deal is that what you pay is the cost of acquiring something. Or you can say what you're acquiring, the fair value of that is the real cost of acquisition. Let's put it again. So there are two aspects of the transaction. If I am buying somebody's business, then I can say what is the value of the business. The fair value of the business is something which I should reflect. Or I say what I paid is the cost of acquisition. Now, the standard says that in a situation when your consideration is only and only paid in the form of shares, the more reliable basis of measurement is not what you paid to acquire, but rather you consider the fair value of what you're getting in return. So because if you want to calculate a purchase consideration, what is important in this case is not to see what you're giving, but it's important to see what are you getting. So one way is looking at the fair value of what is given. Another way is looking at the fair value of what you're getting in return. So the standard setters decided the reliable basis only if the PC is only in shares. That makes more sense. But technically speaking, if you consider the exchange ratios on the basis of fair value, I think if the two companies are deciding to enter into a deal and the swap ratio, exchange ratio is decided on the basis of fair value, they'll never agree to be different. I will never pay you different from what I'm getting. You're getting my point. If I'm buying something from you, what I give you will have a same fair value of what I get. I will never pay you less. You'll not accept the deal. I'll never pay you more because I'm never interested in paying more. So at the end of the day, technically speaking, the fair value of what you give and the fair value of what you get ideally should not be different. Because if that is different, either one of the two parties will stand to gain. And therefore, you will see in most of the questions in the study material where the purchase consideration is only in the form of shares, there is no difference between the fair value of what you give and the fair value of what you receive. It happened in this question. Even in the next question, what we're going to do, you're going to see the same inputs itself. Did you get the answer? Got that? Wonderful indeed. Okay, so I think time now, friends, to give you some break, 10, 12 minutes, and then we start back again. Relax your minds. Something interesting coming after the break. Thank you. Ayush, you said my next question. Okay, your next question was, why is this kind of mix and match in case of consolidated balance sheet, in case of reverse acquisition? Okay. Now, first of all, I think I need to put a little stress on the fact that our accounting is always based on what we call substance over legal form. Now, when you say it is based on a substance over legal form, that means that I need to consider the accounting based on a substance. But at the same time, the legal requirement to present a consolidated balance sheet lies upon A in the given example, which is the legal acquirer. So when you're going to present the balance sheet, the liability to present the balance sheet lies on the acquirer, which is the legal acquirer. So when you represent the number, that is the number of shares, you're representing the number of shares from the point of view of A itself. But the accounting is all based on the substance, that ultimately who is the acquirer in this case. And that is the reason when you look at the substance, you say that B is the acquirer. So you capture the assets liabilities of A at a fair value. It's all because of the concept of substance playing, you can say, a top level as compared to the legal form of the things. So presenting things from the point of view of A, legal acquirer, but accounting is substance, that is considering B as the accounting acquirer. Right? I hope you got your answer on that, Ayush. Great. Okay, now let's come to the next area, that is again reverse acquisition, but we want to now look at an illustration where a new entity is created. So let's, I think, go to another question in the study mat. So there is a question in the study material which is explaining the inputs on reverse acquisition. It's a very interesting question. And that is illustration number 38. Illustration number 38 in the study material. Let me just zoom this to you. So illustration, oh. Just a second. I hope the file got saved. My God, something went wrong. Is the entire file got corrupted in this case? I don't know. Let me just check this out. Oh my God. I think the file got corrupted and it's not saved. Oh my God, this is dangerous. I hope you made a note of the points and all. Okay, let's come to the illustration number 38 now. So this is on the concept of reverse acquisition. I'm looking at question number 38. I'll search the file, later. I hope I get that file. But right now it's not visible. So dangerous. We've done some heavy bits since morning, I guess. Okay, let's begin with illustration number 38 in the study material, which is again on the concept of reverse acquisition. But this time you'll see a new entity is getting created in this case. Let's read. It says AX and BX amalgamated from 1st January X2, and it says a new company ABX is created. So we can very clearly see that a new company is created. So can I outrightly make a statement at this stage, which I said, earlier as well? Can I see if a new entity is created and the consideration is in shares, undoubtedly a reverse acquisition? Reverse acquisition. Agreed?
Yes.
That's absolutely correct. Makes logical sense. So, already noted on that. That's great. Good. Thanks. Now let's, I think, go further. Nothing much to see in the balance sheet right now. It says ABX issued a requisite number of shares to discharge the claims of equity shareholders of the transferor company. Also, new debentures were issued in exchange of the old series about the company. We're required to show a note showing the purchase consideration and the discharge, and also make the balance sheet of ABX as well. So the focus is on the PC because the reverse acquisition mainly has got the concept to PC. Now, A part we can't do at this stage because I'm yet to understand the concept of common control. So we'll do that later. Then it says, assuming BX is a larger entity and they will take a control of the entity of ABX. He's indirectly telling you that BX is supposed to be, you can say, the accounting acquirer. He's very clearly said that BX is the larger entity getting the control of ABX, but I will still calculate my calculations to identify that BX is the accounting acquirer. And I'm also given the fair value of the net assets of both the company, the PPE, the inventory, and the fair value of the business is given. Okay, so let's, I think, begin with the 6 steps, because we know almost now that it is a reverse acquisition because the consideration is paid in shares only. Very clearly given that they will issue a requisite number of shares. So I think it's undoubtedly going to be a reverse acquisition. Let's begin. So illustration number 38 is what we are solving in the study material. We'll first apply our step number 1. So the first is to determine the accounting acquirer. We need to determine the accounting acquirer in this case. So I think we'll first outline the parameters with the help of which we identify the accounting acquirer. We know the purchase consideration, I would say it's not mainly in shares, it's only in shares, and a new entity is created. So the purchase consideration is only in shares. And when I say it's only in shares, I think the immediate thought which should also come to the mind is the PC is not the fair value of what you're going to give, but the PC is going to be the fair value of what you're going to receive. And that's another thought. And then we're also given that a new entity is created. The new entity is created. So one thing is very clear, that one of the existing companies is going to be, you can say, the accounting acquirer in this case. Because when a new entity is created and the consideration is only in the form of shares, one of the two companies will get a major shares in the new company. Let's, I think, work this out. Let's, I think, now work this out. Let's come back to the details. Now we're given that ABX will issue requisite shares to discharge the claims of the equity shareholder. Now, can I say the claims will be to the extent of fair value of the business? The fair valuation of the business of AX and BX is given. So when ABX will give them a requisite number of shares, he needs to give them as many shares that discharges them equal to the fair value of the business. But ABX will issue the shares at a face value. Because ABS is a new company, it's not an existing company. So the issue price of the shares cannot be other than the face value. So let's take the fair value of the business. So we have got AX and we have got BX, and we know the fair value of the business. So we've already seen the fair value of the business is 11 and 14. So this is 11,000. And this is 14,000. And if we calculate the number of shares, which will be issued by ABX to the shareholders. Let's divide this by the face value. He's give them 1100 shares. Let's divide this by the face value. He's going to give him 1400 shares. So ABX will give 1100 shares to AX and 1400 shares to BX. So the total number of shares to be issued by ABX is going to be a total of 2500 shares. And I think on this basis now, we can calculate what is the percentage AX gets in ABX and BX gets in ABX. So let's work this out further. So we have got AX and BX. So AX gets 1100 shares out of 2500 shares in the new company. BX gets 1400 shares out of 2500 shares in the new company. So let's see what is the percentage which each of these companies obtain. So 1100 by 2500, he gets a 44% stake and he gets a 56% stake. And let me also ask you, do you need these percentages? Because as I said earlier as well, do you think we need these percentages? Because I'm already given the question that BX is the larger entity and he's getting a control over ABX. But do I need these percentages? And that's yes. Because in order to calculate my purchase consideration, we need these percentages in any case. So even if the question tells you who is the accounting acquirer, you must still do these calculations in any case. So we can say he is getting a control over the business. And since he's getting a control, we can say the accounting acquirer is BX. The accounting acquirer in this case is BX. He is getting a 56% control over the company. Okay. So this is step number 1. Now let's go to the step number 2. So in terms of the step number 2, we need the date of acquisition. And I think that's pretty simple and straight, no complications. On the date of acquisition, I am clearly given at the very start itself that AX and BX were amalgamated on January X2. So there is no other contrary data. So date of acquisition is January X2. Then we go on to the step number 3A, and that is the calculation of the deferred tax. And are we given any information on the tax rate in the question? I guess no. Since no information is given on the tax rate, and therefore we can say there is no deferred tax implications. The tax rate is not in the question. And therefore, the concept of deferred tax is not applicable. Now, we go on to the step number 3B. So step number 3B, we need to get the list of the net assets and of course of the accounting acquiree. We need the net assets of the accounting acquiree. So would you like to tell me who is the accounting acquiree in this case? Can I say accounting acquirer? The accounting acquirer is BX. So who is the accounting acquiree in this case? Can I say the company AX? And that's right. So the accounting acquiree, that's right, is going to be AX. So we're going to consider the fair value of all the assets. And I think there were 3 assets which we were given as far as the fair value is concerned. Let's go back to the balance sheet. So you can maybe keep the illustration in front of you. Illustration 38 from the study material. So I guess PPE, I am given the fair value is 9,500. So PPE, we consider the fair value 9,500. Rest, I'm just going to pick up from the balance sheet. So whichever fair value is given, we'll take that. Rest, we'll just start picking up the information from the balance sheet itself. So next we are given the investments. And I think investments, we are not given any fair value. We're just given the fair value of PPE and the inventory. So investments remains at 1050. Then on the inventory, we have the fair value, which is 1300. Inventory is taken at 1300. So this is at a fair value. Inventory is at a fair value. Rest, all the book values, fair values are common. We are not given any information. Trade receivable is 1800. Trade receivable is 1800. The cash and the cash equivalence is, I guess, 450. And then let's consider the liabilities. Liabilities, we are given there is a borrowings 12% debenture, that's 3000. So we are given the debentures, that is 3000. And then there is a trades payable, that is 1000. I think that's it. No exceptions, nothing is given. So there's no items of exceptions in the list, just simply the balance sheet items. So let's see what is the net assets. I think it's coming to 10,100, I guess. Correct. Right. So I think nothing too technical so far. I think the crucial step begins when you come to the step number 4. So now let's go on to the calculations of the purchase consideration, the step number 4. Now that is the crucial step. So step number 4, which is the calculation of the purchase consideration. Now we're going to do the calculations in 2 different parts. First, we are going to calculate who paid the consideration ABX. But we need to calculate that if the consideration was paid by BX, how much he would have paid on the basis that he wants to maintain a 56% stake. Because we've already seen the calculations in step 1 that post-business combination, BX is attaining a 56% stake. So we're going to do the calculations in 2 parts. So we know that the consideration is paid by ABX. ABX paid the consideration, but I will not consider what is the consideration ABX paid. We are going to consider if BX would have paid. If BX would have paid, I want to calculate, and the assumption is that he wants a 56% stake in the new company. And he wants a 56% stake. So how much he would have paid if he wanted a 56% stake in the company? So can I say, let's go to the balance sheet of BX, get the number of shares in the balance sheet of BX. So if I go to the balance sheet of BX, I guess BX in the balance sheet has got how many shares? BX has got a total of 700 shares and AX has got a total of 600 shares because the shares are 10 rupees each. So BX has got a total of 700 shares. I want to calculate if BX would have paid the consideration, how many shares he would have issued to AX in order to maintain a 56% stake in the company. So let's come back on the agenda. So we can say if I calculate this, BX has got 700 shares. Let's assume he would have issued X number of shares to the shareholders of AX so that he is able to maintain a 56% consideration. Let's calculate what would have been the value of X in this case. So how much will be the value of X? Is it coming to 550, I guess? Just see, is that coming to 550, I think? Yes, I think so. That's right, absolutely. So we get X. BX would have issued a total of 550 shares to the shareholders of AX. So let's calculate the fair value of the shares issued. But the problem is I don't even have the fair value. So I think another thing which I need to do at this stage is I need to organize the fair value per share as well. Because unlike the previous question which we did, the fair value of the shares was clearly given. But in this case, I do not know what is the fair value of the shares of AX and BX. So let's also organize the fair value of AX and BX for the purpose. And for this, you are given the fair value of the business. I'm already given in the question, the fair value of this business is 11,000. And the fair value of this business is 14,000. And based on the fair value of the businesses, we can get the fair value per share. Divide this by the number of shares. And we will get the fair value per share. So I think the number of shares of this company was 600. Is that correct? And I think this was 700. I think that's correct, right? The number of shares in the balance sheet of AX was, yes, 600 and 700 shares respectively. Let's get the fair value of the shares. 11,000 by 600, it comes to 18.33. And this comes to 20. So I've also organized the fair value of the shares as well. That what is the fair value of the shares of AX and BX? Now let's come back to the purchase consideration calculation. So can I say in this particular case now, BX would have issued 550 shares and the fair value of BX would have been 20. So can I say the purchase consideration in this particular case works out at 11,000. 550 shares would have been issued at the fair value of 20. But do we stop our calculations at this stage? No. Because the PC is only in the form of shares, then I should also do an alternative calculation that by issuing this 550 shares, can I say BX would have got a control over the company AX? So can I say the alternative calculation which needs to be seen? How many shares would BX get a control over AX? By paying the PC, he would have got a control over 600 shares of AX. By giving the number of shares, BX would have got the control over 600 shares of AX. And the fair value of these shares is 18.33. So this also gives me the purchase consideration equal to 11,000. And you know what? As I said earlier, I think when Ayush, you were asking me a question, I said generally the deal will be structured on the basis of the fair values of the shares. So nobody is going to gain or nobody is going to lose in this case. So whether you calculate the fair value of what is given or you calculate the fair value of what is acquired, at the end of the day, the results are going to be the same. But still, that does not mean that you do not do both the calculations. You are required to do both the calculations in any case, because this is the more reliable basis of measuring the purchase consideration. Right? I hope I stand clear on that. Okay, wonderful indeed. That's great. So this is the step number 4. Now let's go to the step number 5. So next agenda is the step number 5. And here we calculate the NCI. But I guess again, there is no NCI which is given in this question. I'm not given any status on the NCI calculations. And finally, we need now the balance sheet. We are not Goodwill, sorry, first of all. So step number 6, we are looking at the Goodwill or the bargain purchase gain. And that's going to be simple mathematical calculations. Just add the purchase consideration to which we add the NCI. Compare this with the net assets. And we will be able to get the Goodwill or the bargain purchase gain. So I think my purchase consideration is 11,000. There is no NCI. And what was the net assets? That was 10,100. So I guess we're getting a Goodwill to the extent of 900 in this case. Wow. So I think this is taken care. Now we need to make the consolidated balance sheet as well. Can you tell me the balance sheet is going to be from whose perspective? Is it BX or is it ABX? So when you're going to present the balance sheet, it is going to be presented from whose perspective? Is it going to be presented from the point of view of BX or ABX? And that's right, it's going to be presented from the point of view of not BX. BX is the accounting acquirer. We need to present it from the point of view of ABX, who is the legal acquirer. So let's, I think, look at the balance sheet as well. So we're going to look at the consolidated balance sheet of ABX. And for this purpose now, we need to be careful. I'll just first draw the inputs. Let's take the figures of AX, BX, and get the consolidated balance sheet. So let's take the column for particulars. We take AX and we take BX. Can I say AX will take the fair value and BX will take the book value, and we'll get the consolidated balance sheet on this basis. So let's pick up the information to make the consolidated balance sheet in this case. Okay, so first of all, when I look at the data, now let's look at the items one by one. I think least we forget, we have to take goodwill as well. So one is PPE, and I think one we can take is goodwill. So remember that you need to take the fair value for AX, who is the accounting acquiry, and the book value for BX. So PPE, the fair value of A is 9,500. And as far as BX is concerned, the book value is 7,500. So that works out at 17,000. Then goodwill, I think we have just calculated, it's 900. Okay, next I am given the item in the balance sheet is investments. And investments in any case has got no fair value. So we take the book values itself, that's 1050. And it is 550. So that works out at 1600. And the next I am given the current assets in the balance sheet. And the current assets we have got inventory. Inventory, I think AX has got a fair value. So inventory of AX has got a fair value, which is to the extent of 1300. So these are the only two items where the fair values are given. Rest we are considering the book values itself. So inventory is appearing at 2750. So that works out, I think, at 4050. And then the next item is trade receivable. Trade receivable is appearing at 1800 and 4000. So this is the book value itself. No fair value is given. That makes it 5800. And then next we are given the cash and the cash equivalents. And the cash and the cash equivalents, again the book values, that's 450 and 400. And that makes it a total of 850. I think that's it. This should, I think, give us the total of the balance sheet on the assets side, I guess. 17,900, 1,600. So I think this works out at 30,200 is the total asset side of the balance sheet. Great. Now let's consider the equity and the liability side as well. Same columns. So let's consider the equity and the liabilities. A column for AX, BX, and the consolidation. So this is AX, again, just to keep it clear, fair value. BX, we considering the book value and the consolidated balance sheet in this case. Let's begin with the equity and the liability section in this case. Okay, now in terms of the equity, we need to consider the equity share capital, which has got a face value 10. Now, would you like to tell me what will be the equity share capital in the balance sheet? So how much are you going to show the equity share capital in the balance sheet in this case? Let's get the data from your side. I think that is the crucial point now. what is the number, what is the value? So I think I'm just going to, quickly take you further on the presentation out here. Now, if I look at the balance sheet out here, just have a clerk look on this. This is important to understand. Then I'll put it down in the balance sheet as well. Let's, I think, maybe cut this. Now, watch this carefully. So now we're looking at the share capital in the balance sheet. Now watch this carefully, that how you're going to present the inputs in the balance sheet in this case. Now, when you're going to present the information in the balance sheet, no, this is not the one. This is for the common control, I guess. We want the other one. Yes, this is the one. Let me just crop this up. Now we're looking at the number and the value in this particular case. Now watch this carefully as we look into the details on this. Now, first of all, you can see the number is appearing at 1250. 700 shares of BX and another 550 shares, which is computed to be given to AX. Earlier, when we were taking the balance sheet in case of reverse acquisition, no new entity was created. And in this particular case, a new entity is created. So when I'm going to present the number, I will consider the acquirer, the accounting acquirer itself. It is when the new entity is created. So this is the existing shares of BX and the further shares which are issued, which is to the extent of 550. So 700 shares plus another 550 shares, that makes it a total of 1250 in terms of number. So when a new company is created, in this particular case, we will consider the shares of the accounting acquirer and the shares which he would have issued, and that's the number which is going to be reflected. Next, the other input is that these shares were issued at the rate of 20 rupees. The issue price of these shares was 20 rupees per share, out of which 10 is the face value, and the remaining 10, that becomes a share premium to be reflected in the other equity of the balance sheet. So I hope you got the dots connected. So when you're going to present a consolidated balance sheet, when a new company is created in a reverse acquisition, here now the calculations are purely from the accounting acquirer perspective. The number of shares of the accounting acquirer plus the shares which are issued and any excess that becomes a premium in the other equity. So let's come back on the agenda. So the equity shares in this case in terms of number is going to be the number of shares of BX is 700 and the number of shares which is issued is to the extent of 550, and therefore this comes to, and each share is 10 rupees each. So this is, I think, 1250. So 12,500 is the equity share capital in the balance sheet. Next. So the next item in the balance sheet is the other equity. Let's take BX into account. So as far as BX is concerned, the other equity is appearing at 2,700. So we can take this as 2,700 plus there is a premium 550 into 10. So that is 550 into 10. So 2,700 plus 5,500. The other equity becomes 8,200. So this is the amount of share premium which is added to the other equity. Okay, this is done. Then let's come to the liabilities, non-current liabilities. And I think debentures, they were given new debentures, I guess. So they were given new debentures which were same series. So we've got debentures that is 7,000. So debentures, new series are given to them. So this is existing, I guess, 3 and 4. The existing debentures are 3,000 and 4,000. So they're given new series of the same debenture that comes to 7,000. And then finally, in the current liabilities, I guess we are just given the trades payable. That's it. So there is no NCI. So this is on the current liabilities. Trades payable is 1,000 and 1,500. That makes it a total of 2,500. Let's see the total of the balance sheet. Let's see if this is agreed or not. So 12,500 plus 8,200 plus this comes to 30,200 is the total balance sheet, and I think it is matched. I think the assets, yes, and the liabilities equally match. So this is the consolidated balance sheet of reverse acquisition in this case. Wow. So now out of 3 inputs, we're done with 2 inputs. We're done with the concept of acquisition accounting. We're done with the concept of reverse acquisition, where I did 2 cases with you, new entity created and new entity not created as well. Now we come finally to the last area, and that is common control transactions. Let's go ahead. Now, this is a crucial agenda to explain that is a common control transaction. So I'm going to do my discussions now in terms of 2 parts. One is to understand how do you identify that it is a common control transaction. And number 2, once you've identified that it's a common control transaction, how does the accounting of a common control transaction occur? So I'm going to divide my discussions in 2 parts. One is to understand when it is a common control. How do you say that yes, it is a common control? And the second input, what we need to discuss is that once you decide a common control, how does the accounting take place? We've done the acquisition accounting, reverse acquisition, then we'll see the common control accounting. Now watch this carefully. So we're looking at the common control transactions. We're looking at the common control transactions. So the first agenda is to identify how do you say that it is a common control transaction. Now, I'll explain with examples, but let me first, I think, give you the conceptual understanding of this area. So what I've done, I've converted this into, again, a simple 3-step model. In order to decide that it is a common control transactions, we are going to work on a simple 3-step model. So again, 3-step model. Yes. The first thing is we need to consider that are the same parties. Don't worry, I'll document that as well. You're going to consider are the same parties were having a control earlier and the same parties are having a control now as well. So we need to see, first of all, I'll just pen down the 3-step model to you. We'll see the questions as well. So the step number 1, so let's put it as a 3-step model. So when you would identify the common control transactions, we would apply a simple 3-step model. And in this case, the first thing is we'll say that the same parties had a control. The same parties had a control. I'll put it as oblique joint control. The same parties had a control or a joint control. You can say pre and post business combination. I'll take a very simple example to just explain this for the time being. Now let's imagine a simple example to illustrate this. Let us consider in this case, there is a company X Limited and there is a shareholder, Mr. A. Let's say he has got a 75% stake in this company. So let's say there is a shareholder, Mr. A, who's got a 75% stake in, let's say, company X Limited. So I would say Mr. A controls this company because he's got more than 50% stake. So he undoubtedly controls the company. Now, what is done in this particular case is that this company X Limited is got, let's say, 2 divisions. This company X Limited, let's say, has got 2 divisions, division X and a division Y. So this company has got, let's say, 2 divisions. They've got division X and they've got division Y. Now this company decides to go in for a demerger. Now, when I say that this company decides to go for a demerger, so what they decided, the division Y in this company is going to be segregated and a new company will be created. So what they do, that this company is comprising of two divisions, X and Y. So they will segregate the division Y and create another company altogether. So they create a new company, Y Limited. Division X will remain in this company, and division Y, you create another company that is Y Limited. But the shares of Y Limited are given to A Limited shareholders itself. Sorry, the shares of Y Limited are given to the shareholders of X Limited itself. So the company basically demerges the division and the shares of the new company are given to the existing shareholders of the company X Limited itself. So in this particular case now, Mr. A is not only having a control over this company, he's got a 75% stake in this company, but Mr. A will also be getting a control over this company as well. Because he is the shareholder of X, and when the company Y is created, the shares of Y is given to the shareholders of X Limited, let's say in the same ratio in which they had the holdings in X. So in this case, you can say Mr. A is now in the control of X as well as Y Limited both. So what you need to prove in terms of the common control in step number 1 is that the same parties had a control pre-business combination and post-business combination. So Mr. A had a control over X before the business combination, and Mr. A also has a control over X and Y post the business combination. The same parties have the control over both the old and the new companies pre and the post business combination. If you can prove this, the first parameter is met, but that does not mean that you go to account under a common control transaction. This is only the first parameter which is met, and therefore it means that yes, there is a possibility that a common control can apply. Second, once this condition is met, we go on to the second step thereafter. Now, in terms of the second step, in my example, there is a single party, Mr. A. But there could be a lot of people together. Let's say there is Mr. A and Mr. B, and they jointly control X. And now also Mr. A and Mr. B, let's say, jointly control Y. Now, if there are two parties, the second step would apply only if there are two parties. If there is one party, then the step number 2 is not to be applied. But if there is more than one party, then you will apply the step number 2. If there is more than one party, then you will apply the step number 2. And you will say that, okay, did both Mr. A and B, they entered into a contractual agreement? They decided by a written agreement. So when they say they entered into a contractual agreement, there should be a written agreement between both the shareholders. So in my example, if I say Mr. A and Mr. B together jointly control company X, then I'll put a question that Mr. A and Mr. B, did they enter into a written agreement with each other that they will continue to act together? If there is no written agreement between A and B, then we can say a common control accounting will not apply. So the parties who have a joint control over the entity should have a written agreement with each other to act jointly as well. So this will be seen only if there are more than one party who is achieving together a control, a joint control. Then once you satisfy this, we go to the step number 3 and decide that this is not transitory. We need to decide that this is not transitory. Now you will say, what is not transitory? Don't worry, I'll explain that with an example. But the basic objective of step 3 is that you should not be doing any kind of manipulative plannings. The basic role of this step number 3 is to avoid any kind of manipulative plannings. Companies should not be given the advantage of doing a common control transactions unless and until you're able to prove that there was control, for quite some time in the pre-business combination period. Because companies can manipulate and create an artificial control just a couple of months before the business combination occurs. Now, what I'm saying I'll explain that with a practical illustration. But let's just connect the dots before we go further. So when you say that there is a common control transactions, you need to apply a three-step to decide whether you are under the purview of a common control transaction. At the first instance, we'll say the same parties before the business combination had a control, the same parties after the business combination should get a control. Second, we should say that if there are more than one party which has got a joint control over the entity, have they entered into a contractual agreement with each other or written agreement with each other? If yes, I will say, okay, let's now prove that the control which was there before the business combination was not something which was artificially planned. It was something, which was not transitory. It was something which was there for a couple of times. Now, how do we apply this? Let's, I think, understand this. I am carrying 2-3 small little questions on this area to give you clarity. These are also given in the study material as well. So I think let's have a look at this particular question. Let me just zoom it across. This is also there in the study material as well. Let's look at question number 16. We'll apply the three-step model to understand whether we fall under the ambit of common control accounting or not. So this is B. I think it's missing. Let me put it as B. Now let's read the inputs. It says ABC and XYZ are owned by 4 shareholders, B, C, D, E, each of which has got a 25% shares in each of the company. Now let me ask you a few questions. You need to vouch me. There are 4 shareholders, B, C, D, E. They've got 25% stake in each company. That is the company ABC and the company XYZ. Now let me ask you, is company ABC jointly controlled by these shareholders? Is company XYZ jointly controlled by the same set of shareholders? So are both these companies having the same people controlling the companies? Can I say that means they've got a common control? It's like, it's like this, that the shareholders are sitting on the top. The shareholders are sitting on the top, and you can say there is a company ABC and there is a company XYZ. Now you can see in this case that these common set of people control ABC and these common set of people control XYZ. So if there is any dealing, which happens between these two companies, are they under the common umbrella of the same set of shareholders? Yes. Would it result in a common control transactions? Yes, provided the 3 steps are met. I hope I'm clear, right? I hope I'm very clear on my thoughts on that. Great. Okay, so now let's read further. It says the shareholders B, C, D, not E, have entered into a shareholders agreement in terms of governance of ABC, and due to which they exercise a joint control. Now let's look at this. I said the step number 1 is that same parties have a control. And the step number 2 is that there should be a written agreement. Now the written agreement is only between BCD and not E. Therefore, we will consider only BCD. These are the 3 shareholders who have control, joint control over ABC and joint control over XYZ. Now, if you can prove it to me that the joint control which BCD has on ABC and BCD has on XYZ is not something which occurred in the very recent past. If you can prove it to me that this joint control has been there for quite some time, then I would say the common control transactions would apply. Basically, this question is focusing on the step number 1 and to some extent on the step number 2, but not on 3. So in this case, we can say that ABC and XYZ are jointly controlled by BCD. So any transaction between ABC, XYZ will come under the scanner of a common control. Let's go ahead. Let's see another question. So let's have a look at another question. extension of the same one. So let's have a look at another question now. The facts are exactly the same. And now let's see further inputs in this case. It says, in the following group structure, ABC, XYZ are owned by 4 shareholders, each of which has got 25%, same facts. However, there are no agreements between any of the shareholders that they will exercise the voting power jointly. Can it come under the purview of common control transactions? The same parties jointly control both the companies, but they've got no written agreement with each other to act jointly. Can it come under the purview of common control? Say yes or no. And that's rightly said. Of course, no. For this reason that there is no agreement, I would say the step number 2 in this particular case will fail. And if the step number 2 will fail, then the appendix C, that is the accounting for common control transactions, is not applicable. So this, if there is any transaction between ABC and XYZ, we will account it as an acquisition accounting or reverse acquisition depending on the facts. But it cannot apply. So what is important is same parties control, but what is more important is that there should be an agreement between them that they're going to act jointly together. If they don't have an agreement, you're not allowed to be covered under common control. Let's now see the application of the third step. Now let's have a look at the application of the third step in this case. Now this is an interesting step. Watch this carefully. This is an interesting step to watch. Now let's have a look at the question number 18. How we need to prove that the control is not transitory in nature. Now this is crucial. Just watch this carefully. This is going to be slightly little technical. So I'll explain that slowly and steadily. This is the application of the third step in this case. Let's have a look. It says ABC had a subsidiary, namely X Limited. It says ABC had a subsidiary that is X Limited. So I think I'll cut this B. So you can say that ABC has got a control over X Limited. This is the position before, which is acquired on 1st April 2000. So this control is acquired on 1st April 2000. ABC acquires all the shares of Y on 1st April 2017. So in this particular case now, ABC has got a control over X and ABC also gets a control over Y. But then he acquired these shares. These were acquired on 1st April 2000 and this was acquired on 1st April 17. Then he says ABC transfers the shares to Y, shares in Y to X. So what ABC does, he sells off this subsidiary to X Limited. So once ABC sells the subsidiary Y to X Limited, this is the structure. It becomes a case of a chain because now the company Y belongs to company X because the parent company ABC sold the company Y Limited to X Limited. How should the above transfer of Y into X Limited be accounted for in the consolidated financials of X? Now please watch this carefully. Now, one thing, the focus is on step number 3, and I'm just going to give you the insights in terms of step 3. Now, watch this carefully. We can see that company ABC had a control over company X. And then company ABC also acquired a control over Y. And then the company ABC sold this company Y to the subsidiary X, and that's how the chain became. Now, please hear this very carefully. If this clicks, it clicks in a second. I would question ABC, why did you acquire Y? You could have told X that he can acquire Y directly. I'll put a question to ABC that why did you acquire the company Y? You could have told your subsidiary that let him directly acquire Y. Why did you do this? And I'll tell him, I'll tell you, boss, why did you do this? Once ABC acquires Y, these two companies come under the common umbrella of ABC. Because now ABC has got a control over X and ABC has got a control over Y. So if there is any dealing between X and Y, they will be considered between the parties under common control. So I will tell ABC, boss, you acquired this company because you wanted to bring them under the common control umbrella. And now, after you did this, then the transaction occurred between X and Y. After you did this, then the transaction occurred between X and Y. And therefore, now you're telling me it's a common control transaction. I'll tell him, boss, let's do a walkthrough. Let's do a walkthrough in such a way, let the company X acquire Y directly. Let's not take the stage. Let's not take the stage. Let's consider that X would have acquired Y. I will say now, was Y under the control of A earlier? No. So can I say if Y was not under the control of ABC earlier, therefore any transaction between X and Y will not be under the common control transaction. So I will accuse ABC that you intentionally entered into a transaction of acquiring a control over Y, and that also you did it just, 1 day before. I'll say you did it 1 day before. On the 1st of April, you bought the company and you bought it under the common umbrella. And then the company X and Y dealt with each other, and then you say common control transaction. I'll say, boss, let's make a walkthrough that if you would have not acquired Y, then company Y was never owned by ABC earlier. ABC never had a control earlier. The control came only later. So the same parties were not controlling earlier and now. So in this case, I would say it's not a common control transactions. Did you get my thoughts? Did you get my thoughts, Claire? That's a very crucial point indeed. And this is called not transitory, that companies do not artificially create a structure where they try to bring companies under the common umbrella, because the common control accounting allows you accounting on the basis of book value. The common control transaction allows you to do the accounting on a pooling of interest method, and the standard setters wanted that the pooling of interest method should be restricted only when there is a related party transactions. You cannot create a relation a day before and then enter into transactions to say that it's a related party transactions. Did you get the point clear? Or you want me to put this again, or am I clear on my thoughts? I didn't get any yes on that. So what do I presume? Clear with the agenda? Yes, it is because there is a 1 day gap. Yes, you're right. But at the same time, if you tell me that how many days of gap is acceptable, I can't give you any deadline on that. Because when it says, the standard says that the control is not transitory, the mere objective is to prove that it should not be a part of the planning. Now, whether this planning is done 2 months ago or 6 months back, that is something which professional judgment will require. The auditor will have to sit down and make an assessment that this kind of transaction is being tried to be manipulated or not. Did they create an artificial control? But I would say if, let's say, for example, ABC acquired this company Y 2 years back, for example, 3 years back, then I don't think so I can accuse ABC that he bought company Y under the umbrella. Now, if he bought this company Y 3 years back and X and Y deal with each other, I think it can be, well said that yes, they are supposed to be under a common control transaction. But when you smell that planning, that, a couple of days ago, a couple of months ago, this kind of deal was being done, I will always tell the company ABC, what was your point of acquiring this company? You could have told X to directly acquire this company. First you acquire it, bring it under the common umbrella, and then X and Y enter into the deal, because you want to take the book value accounting, advantage in this case. Right, friends? That's great. Okay, so this is one aspect done. Now let's go to the next agenda. Having understood how do you identify a common control transaction, so let me just connect the dots in terms of 3 steps. The first is you need to see that the parties which have a control before and the same parties have a control after. If there is one party, no need of step number 2. But if there is more than one party, a written agreement has to be proven. And then step number 3, prove it that there is no manipulative intentions. The companies which were earlier under the common control was not as a role of what we can say sajish. So if you've got that control for quite some time, it's fine. But if you're trying to create that control artificially, not acceptable. That's the 3 step. Now, coming to the next agenda, and that is accounting. That is the accounting. How would the accounting take place in the books of the old company, I would say, and the new company? Because in most of the cases in common control, what you're going to see is a case of a demerger. Most of them. I'm just taking a presumption that most of them, you will find that there is a company, let's say AB Limited, which has got, let's say, a division A and B. So what will happen in this case, that this company AB Limited will keep a division A with him, and he will create, let's say, a new company B Limited and give him the division B. So generally, you will see that common control would generally arise, let's say, in terms of a demerger. So a demerger means that company which has got 2 divisions demerges one division into another company, but the shares of that company goes to the shareholders of the existing company itself. So we need to basically see how the accounting will be done. I'll call this as an existing company. And how the accounting will be done, I'm going to call this as a new company. So when we're looking at a common control transaction, my main focus is in terms of demerger accounting, where we're looking at a company demerges a division into a separate entity altogether. So the company which transfers the division, I'll call it as the existing or the old company. And this is the existing, or we'll call it as the old company. And the company B Limited, which is supposed to be the new company. So let's see how the accounting will be done in the books of old and in the books of new company. Now watch this. So let's see how the accounting is going to be done in the books of old as well as the books of the new company. So let's see the old company and let's see the accounting in the books of new company. The basic objective of the old company is to close those assets and liabilities which are given to the new company. So as I said, the basic objective in the books of the old company is to close all those assets and liability which are taken over by the new company. So what he'll do, he will debit those liabilities at a book value and he will credit those assets at a book value. And since the company AB Limited is not receiving anything from B, because B will give the consideration to the shareholders of AB. B Limited will give the consideration to the shareholders of AB. So AB company does not get anything. So he will not say that I'm going to get shares from B, because B Limited will give all the consideration to the shareholders of AB. So he gets nothing. So he just need to close the assets and liability, and any balancing figure in this entry can be directly captured in equity. It can be directly captured in terms of equity. Any gain, any loss directly adjusted in the statement of changes in equity, that is equity. That's it. The idea is only to close the books of accounts. The new company will capture the assets at a book value, not fair value. Not fair value. He will capture the liabilities also at a book value. So in a common control, the concept of fair value is not applicable. So he will capture the assets and liabilities acquired at a book value itself, and he will issue the purchase consideration, let's say by giving shares or whatever. So this is the purchase consideration, let's say given in the form of shares, which will be recorded at a face value, not fair value. Not fair value. So he will record the shares issued at a face value, all the assets and liabilities recorded at a book value, and the purchase consideration recorded at a face value. Now, if there is any difference which arises in this entry, that difference will also be adjusted directly to equity. So no goodwill will ever arise in the books of the new company as well. So in this case also, everything, whatever is the difference on the debits or the credit side is going to be settled in equity. The accounting is as simple as that. So he closes the assets liabilities at a book value. He captures the assets liabilities at a book value, shares at a face value. Differences in both the books of accounts is going to be captured in equity, no goodwill. It's just like pooling of interest. Let's pool everything together. And you pool everything together, and that's how the accounting is done. I think let's now look at a question where we're going to see the accounting of this in the books of old and new company together. So we've got an illustration in the study mat. So on the common control, let's see, there is a question in the study material on this. Yes, there is one question, enterprise, and there is another question, Maximini. Illustration number 37. Let's go to illustration number 37 in the study material. Let me just crop this and share it with you. So we'll see the aspects of demerger very clearly stated in the question. Right, so let's have a look at the illustration number 37. So let's read the facts and see the inputs. So I am given in illustration number 37, it says Maximini has got two divisions, Maxi and Mini. So he's got two divisions, one is Maxi and one is Mini. The information about the assets and liabilities on 31st October X2 is given. So we're given the details for the Maxi and the Mini division on a separate basis. We don't need anything further at this stage. Then it says in the additional information, it is decided to form a new company Mini to take over the assets and liabilities of Mini division. So you can see that this is a case of a pure demerger happening. The company Maximini has got two divisions, and one of the divisions is being created as a separate company, demerge the company. Accordingly, Mini is incorporated to take over at the balance sheet figure book values the assets and liabilities of that division. Mini is going to allot 5 crore shares of 10 each to the members of Maximini. Now that is important because when you say it is going to be a case of a demerger, what is important is the consideration is given to the shareholders of the existing company. A demerger happens only when the purchase consideration is given to the existing shareholders of the company. And in this case, Maximini members are getting the shares from Mini. It says the members of Maximini are therefore to become the members of Mini as well without having to make any further investment. So is it good to say that Maximini was earlier under the control of the same people, and even Maximini and Mini is still under the control of same people? So you can say the transaction is happening between Maximini and Mini. Just visualize this. Just visualize this, that there is a company Maximini and there is now a company Mini. So we can say there are certain shareholders, maybe one shareholder or maybe certain set of shareholders. So these shareholders had a control over Maximini. The same people have got a control over Mini as well. So when they deal with each other, they're under the common control of the same set of shareholders. So I am indirectly now assuming that, the shareholders have entered into an agreement. That's one. And I'm also assuming that the control is not transitory. So I'm considering that, yes, both these companies are under the common umbrella of the same set of people holding the company. So when they enter into transaction, it's a common control transaction. Okay, so now it adds on further. You are required to pass journal entries in the books of Maximini, that is old company, and in the books of Mini, that is new company. Also prepare the balance sheet of the two companies on the morning of 1st November. Well, the morning does not mean anything. We're just making the balance sheet on the next day. We're giving the balance sheet on 31st October. We're making it on 1st November. Then he says directors of the two company ask you to find out the net asset value of the equity shares pre and post demerger, and then comment on the impact of demerger on the shareholders' wealth. So there are 3 requirements in the question. We need the entries in the books of Maximini and Mini, old and new company. We need the balance sheets of the company, and we need the net asset value per share to calculate the shareholders' impact. Let's begin. So at the first instance, this is illustration number 37. And we're going to look at the entries in the books of old and the new company, with which we will draft the balance sheets as well. So this is the books of Maximini, old company. And this is the books of Mini, which is new company. So let's call this as a new company. And let's call this as an old company. So the objective in the books of old company is to close the assets and liabilities. That's it. So I think you can open the illustration 37 in front of you, and I'll just pick up the information from the question. So in this particular case, if I look at the balance sheet of Mini division, because they are closing down, so I will first of all close the liability. So on the liabilities, I am given current liabilities, debit the current liabilities to the extent of book value. And then there is a loan also appearing in the balance sheet, debit the loan also at 100. The idea is to close the liabilities and assets. So debit the liabilities, and the only assets appearing, one is the PPE that gets a credit, and one is the current asset that gets a credit. The PPE of the Mini division is 200, and the current assets is supposed to be 300. So current assets is 300 and the PPE is 200. That's it. So we've done the entry debiting the liabilities, crediting the assets. So any difference in this entry will be taken where? Directly taken to equity. So that is a loss. You can also give it an interesting name, and that can be called as a loss on demerger. But at the end of it, this loss is going to be taken directly in terms of equity, though you can call it as a loss on demerger. And I think this is coming to, I guess, 300. So this is the entry in the books of Maximini, who captures the closure of the assets and liabilities, and the balancing figure is taken to equity, loss on a demerger. Let's now look at the entries in the books of Mini. He will now capture the assets at a book value, that is 200. Capture the current assets at a book value, that is 300. Capture the liabilities at a book value, that is 100. Capture the loans also at a book value, that is 100. So basically reversing the entry. In simple words, you can see he's just reversing the entry, capturing the assets and liabilities completely at a book value. And then he is going to allot equity shares. And I think, how many shares is he allotting? He is allotting a total of 5 crore shares of 10 each. So the consideration is given in the form of 5 crore shares of 10 each, and that works out at 50. Here again, the balancing figure in this entry is going to be taken to equity itself. So here I think we're going to get a difference of 250. So this difference is going to be taken as equity. So in both the books, whether it is old or the new company, you just need to capture the difference in the equity. No goodwill will arise in this particular case. So this is closure of the books, and this is the takeover of the assets liability completely at a book value. Okay, so the entries are done. Now we can make the balance sheets in this case. So we are required to make the balance sheet of Maximini as well as Mini. And the balance sheet of Maximini pre and post demerger. So we want to get the balance sheet of the companies. One is Maximini, that is pre-demerger and post-demerger. And one is the balance sheet of Mini, which of course is post-demerger because this company was not in existence earlier. So this is post-demerger. So let's take the information from the question itself and we'll fit in the data. So on the non-current assets, we've got PPE. I'm first copying the balance sheet of Maximini as it is from the question, as it is. So we've given the PPE is 300. And then there is current assets, that is 700. The current assets are given to us, that is 700. This is the existing balance sheet. So PP is done and this is done. That's it on the asset side. There's nothing else on the asset side. Let's close this. And then on the liability side, so we're given the equity. And in terms of the equity, we've got the equity share capital is 50. The equity share capital is 50. The other equity in the balance sheet is given 650. Then there is a loan. Then there is a current liability. The loan is appearing at 100 and the current liability is appearing at 200. This is the balance sheet copied as it is. This is the balance sheet which is copied as it is. So this works out at 1,000 and this is also 1,000. This is the existing balance sheet of Maximini picked up from the question itself. Now, what do you need to do to make the balance sheet of Maximini incorporate that closure entry? To make the balance sheet of Mini incorporate the entry which we did in the books of Mini. So I think if I just go back and incorporate the entries, so we can say he's going to record PPE at 200. So PPE is recorded at 200. Remaining 100 is left over. And he's going to record the current assets at 300. So the remaining 400 is left over. His equity share capital continues the same. He also issued an equity share capital of 50. As we can see in the entry, the loan is 100 and the equity is 250. So the equity is 250, the loan is 100. So the loan is gone out here and the current liabilities is 100. So the remaining current liabilities left over is 100. And out of this 650, there was a loss on demerger. So the other equity left over is 350. So that is the leftover other equity. This is 500 and this is also 500. This is 500 and I guess this is also 500. So that answers the balance sheet of Maximini as well as Mini. You can say pre and post demerger as well. But the question is not yet complete. There's one more part, just few more minutes. There's one more part to this. He is now asking us the net asset values of these company and the impact on the shareholders' wealth due to this demerger as well. So let's do the last bit calculations in this case. We want to calculate the net asset value per share. We want to calculate the net asset value per share. Can I say net asset value per share would mean net assets divided by number of shares. Either you take assets minus liabilities as net assets, or you take equity share capital plus other equity. Both way you get net assets. Assets minus liability or the sum total of the share capital plus other equity. So I think we can take the sum total of this. The net assets of this company is 700. So Maximini The net assets is 700. That is pre-demerger. And this is now 400 post-demerger. And in terms of Mini, his net assets is 300. So this is the net assets of these three situations. Divide this by the number of shares to get the value per share. Divide this by the number of shares to get the value per share. So this company has got a total of 5 lakh shares. And this company also has got 5 lakh shares. So this becomes 140, this is 80, and this is 60. So we can see in this particular case, we can clearly see in this particular case, this company had a share value 140, this company has got 80, and this has got 60. Now you can see some interesting inputs coming in. The shareholder earlier had one share of 140 each. Now he's got one share of 80 and one share of 60. Can I say his wealth is still the same? Because earlier he had one share in the company, which was 140 each. Now he's got one share in Maximini 80, one share in Mini 60. His wealth is still intact, equal to 140 per share. So when we say, okay, I think a question was coming. So when we say what goes to equity, that means other equity. Yes, equity means the other equity, that is the SOKI, correct. So I think now we've also proven the fact that in this particular case, the company's shareholders' wealth in this case has not changed. And trust me, in case of a demerger, when everything is taken at a book value, you'll never see that there is any impact on the shareholders' wealth, because at the end of the day, the new company is created at a book value itself. And the shares of that company goes to the existing shareholders itself. So at the end of the day, you will not see any impact happening on the shareholders' wealth. Right, friends. So I think that takes care of a common control accounting as well. Now, all the three kinds of accounting is done. We're done with the accounting for acquisition. We're done for the accounting for common control and the reverse acquisitions. Indus 103 gets completed now. Now, we'll be starting in the next session, which is going to be on Saturday, because I think Thursday there's no class on account of the Christmas. So we'll be meeting you on Saturday when we start with the consolidation standards, Indus 110. I think that's all for the day, unless you've got any questions to ask. Now you're ready to revise all this bit in a complete sense. Do all the questions from the study, practice questions from the past examinations and the RTPs as well. You will get a good confidence in terms of business combination. Right, friends. I think there seems to be no questions on that. Yes, more questions need to be done, of course, to get more confidence on that. Right, friends. So I think it's time to now bid goodbye to you. I think I've already taken a little half an hour extra to compensate you for the previous one. So thank you very much. See you later. By the way, wish you a very happy Christmas, and we're going to see you post-Christmas. Thank you. Bye-bye and take care. Anji, thank you.